learn with joy.
Hi, hello champions. Good morning. This is your CA Trilok. I am doing well. I hope you are also doing well. In this video, I am going to start and I am going to discuss RTP Descriptive Questions of May 2025. Without wasting the time, let me start with the first question from the chapter Material Cost. This question is based on the concept of EOQ. We all know that EOQ stands for Economic Order Quantity, and the formula of this is root of 2AO divided by C. A stands for annual requirement, O stands for ordering cost per order, and C stands for carrying cost per unit per annum. Look at the question. What they given? Catalyst Limited is a distributor of industrial chemicals, providing the chemical in drum packings. Each drum of the chemical cost 200 rupees from a supplier and the company sell it for 240 rupees. So the company is purchasing at 200 rupees and selling at 240 rupees with the profit of 40 rupees. Annual demand is estimated to be for 250,000 drums. This we can take it as A. This we can take it as A. The cost of delivery is estimated at 100 per order and the annual variable holding cost per drum at 180 plus 10% of purchase cost. So please understand, cost of delivery is estimated 100 per order. This 100 rupees we can take it as ordering cost O. And then they given holding cost per drum 180 rupees plus 10% of purchase cost. So 180 plus 10% of purchase cost. How much is the purchase cost in our question? 200 rupees. So 200 rupees into 10%, 20 rupees. So 20 plus 180, 200 rupees. So holding cost, nothing but C. C is 200 rupees. We know A, we know O, we know C. Okay. Now, based on above data, the managing director calculates the economic order quantity and suggests that it should serve as the foundation for purchasing decisions in upcoming periods. Okay, fine. So ultimately, managing director is going to calculate the EOQ. Next. However, the purchasing manager states that the managing director has ignored his share of bonus of 10% of the amount by which total annual inventory holding and order cost before such remuneration are below 2 lakhs. He further pointed out that suppliers also offer quantity discount on purchase orders, that is, if the order size is 1000 drums or above, the price per drum is only 199.60 compared to 200 when an order between 500 and 999 drums. Let us understand this paragraph. We are going to see one new adjustment in this paragraph. What is that here? There is a purchase manager who is getting the bonus. Purchase manager is getting the bonus. How much is the bonus? 10%. 10% on what? 10% on the amount. On the amount by which total of annual carrying cost and annual ordering cost is below 2 lakhs. Simple. Total of ordering cost plus carrying cost. Okay. Amount of difference between total of ordering cost and carrying cost and below 2 lakh rupees. See, they are mentioning that the maximum ordering cost, carrying cost should be 2 lakh rupees. Below that, how much we incur? The difference between these two, amounts. On such amount, he is going to get the bonus of 10%. See, please understand, the total permitted cost to incur is 2 lakh rupees. But if we incur less than that, 2 lakh rupees, if the purchasing manager incurs less than 2 lakh rupees, whatever the amount saved, or how much ever the cost reduced compared with 2 lakhs, on that reduction amount or saved amount, he is going to get the bonus of 10%. Look at here what the wording that they use. Look at the wording. Ignored his share of only 10% of the amount by which total annual inventory holding and ordering cost before such remuneration are below 2 lakh rupees. Are understanding? And the amount is what? below 2 lakh rupees, how much ever the cost saved, how much ever the cost saved, the total maximum permissible is 2 lakh rupees. Below that, how much we saved? Are you understanding? So that means permitted cost is 2 lakh rupees. Within that, if you incur less than 2 lakh, if the purchasing manager incurs less than 2 lakh rupees, how much ever the cost saved on such cost, he is eligible to get the bonus of 10%. Clear? Next. Apart from this bonus condition, they mentioned discount offer. What is the discount offer? Look at this. If the order size is 1000 drums or above, the price per drum is only 199.60. So normal price is 200 rupees. If the order size is more than 1000 drums, he is going to get the each drum at 199.60. That means 40 paisa discount. Okay. Now what they are asking? Number one. Calculate economic order quantity as calculated by the company's managing director, root of 2AO divided by C. We know A, we know O, we know C. Substitute the values, we'll get the answer. Next. Comment whether Catalyst Limited can look forward to the quantity discount offered for purchasing 1000 drums after calculating total cost considering purchasing manager bonus along with supplier's quantity discount. So please understand. Here they are asking to evaluate the discount offer. We have many questions based on this in the study material also. Just what we need to do, we are going to take EOQ and we are going to take ROQ. EOQ we calculated here and ROQ is 1000 drums. If you place the 1000 drums, we are going to, if you place the order of 1000 drums, we will get the discount of 10%. Sorry, we will get the discount of 40 paisa. 40 paisa per drum. 40 paisa for each drum. Now what we need to do? We need to calculate total cost at EOQ, total cost at ROQ. If ROQ total cost is less, we'll go for 1000 drums order. Or else we'll continue with the EOQ. In this question, while taking the total cost, we need to consider 4 elements. Ordering cost plus carrying cost plus purchase cost plus bonus. This is the additional point. This is the additional point. Are you understanding? All of you. Now, listen to me carefully. Look at here. Look at the solution. Question number 8. Please take question number 8. Look at this. Yeah. So, the formula is root of 2AO divided by C. Annual requirement, ordering cost per order, carrying cost per unit per annum. 2 into 2,50,000. Look at the question. 2,50,000 is the annual demand and 100 rupees is the ordering cost. 200 rupees is the carrying cost. 180 into 10% of 200. That is 200 rupees. So root of, okay, it is already written here. If you solve that, we'll be getting 500 units. EOQ is 500 units. Now the point is we need to evaluate the discount offer. So we need to calculate at 500 ordering quantity, economic ordering quantity of 500 units, reordering quantity of 1000 units. At 500 units and 1000 units, we need to calculate carrying cost, ordering cost, purchase cost, and then bonus. If you make a total, if ROQ total is less, we'll go with ROQ, or else if the EOQ total is less, if EOQ total is less, we'll continue with the EOQ. Are you understanding? All of you? Okay. Now, let us solve this. Look at here. Comparison of total cost considering purchasing manager bonus and supplier quantity discount. First one, ordering cost. How to calculate ordering cost? Number of orders into ordering cost per order. How to calculate number of orders? That is A divided by OQ. A divided by ordering quantity. Ordering cost equal to A divided by OQ into O. A divided by OQ into O. What is A? 2,50,000. In the first case, what is OQ? 500 units. 2,50,000 divided by 500 units into ordering cost per order is 100. Look at here. 2,50,000 divided by 500 units into 100, 50,000. Next, 2,50,000 divided by ordering quantity is 1000 units into 100, 25,000. So this is about ordering cost. Next, carrying cost. What is the formula for carrying cost? Average stock into carrying cost per unit per annum. How to calculate average stock? Half of OQ. Half of OQ into C. Half into 500 into 200. Half into 500 into 200, 50,000. Next, half into 1000 into 1, see 10% on 199.60. This is one thing. 200 rupees. See, when you are placing the order of 500 units, 200 rupees is the price. When you place the order of 1000 units, 199.60 is the price. So 10% should be taken on price, purchase price. Okay, accordingly they are getting 99,980. If you make a total 1 lakh rupees at EOQ, 1 lakh 24,980 at ROQ. Now we need to calculate bonus. What is bonus? The maximum is 2 lakh rupees. Within that, how much ever the cost incurred, how much ever cost incurred and cost saved. Listen. 2 lakhs is the maximum cost permitted. Now we need to take the total of ordering cost and carrying cost. Now we'll compare 2 lakhs and total of ordering cost and carrying cost. How much ever the cost saved. How much ever the cost saved. That on such amount 10% bonus. So here it is 1 lakh rupees. So 2 lakhs minus 1 lakh into 10%, 10,000. 2 lakhs minus 1 lakh is 1 lakh, 1 lakh into 10%, 10,000. Next 2 lakhs minus 1 lakh 24,980 into 10%, 7,502. So this is the bonus. Now we need to calculate purchase cost. How to calculate purchase cost? Totally, we are going to purchase 2,50,000 units. And one more thing, many people confused with this. They will take 500 into purchase price, 1000 into purchase price. Please understand, 500 and 1000 are the ordering quantities. Here we need to calculate purchase cost. So take the purchase quantity. Ordering quantity is different, purchase quantity is different. Each order, how many units we are going to order, that is called ordering quantity. Purchase quantity is full year, how much quantity we are going to purchase. Totally demand is 2,50,000 units. So 2,50,000 into purchase price is 200 rupees and 2,50,000 into purchase price is 199.60 will get the cost. If you make a total, here it is 5 crore 1,10,000. Here it is 5 crore 32,482. So cost at 1,000 units is less. Cost at 1,000 units is less. So should we accept the price discount offer? Answer is yes. We need to accept the price discount offer. Okay, now look at here. In the above comparison, the potential savings from purchasing in bulk overweight the higher carrying cost associated with holding more inventory. Thus, capitalist limited may look forward to the quantity discount offered at may look forward. They can look forward for the quantity discount. Have you understand this? One is based on EOQ and second requirement is based on the evaluation of the discount. Evaluation of the discount. One new point what we learned in this question is product purchase manager bonus. Clear about this? Understanding? Okay. Look at the second question based on the labor cost. So before proceeding to that, we need to understand valuation of okay. Before looking into the question, I want to explain a small point. You need to understand three terminologies: CTC, gross wages, or we can call it a total earnings. Total earnings, which is also called as gross wages, and then net earnings, which is also called as take home. Please understand what is this total earnings means. Employees will be getting the benefits. Employees of the company will be getting the benefits in different names. What are the different names possible? Basic wages, dearness allowances, telephone allowances, house rent allowances, travel allowances, leave travel allowances, special allowances, conveyance, uniform allowances, children education allowances, like this. Many allowances will be getting by the workers of the company. Now, if you make a total of this, that will be called as the total earnings. Let me take an example. Total earnings is 1,20,000. From this 1,20,000, we have to make certain deductions. What is the deduction means? Number 1, TDS. Number 2, PF. Number 3, ESI. Number 4, PT. If any other deduction is there, such deduction also to be included in this. Normally, this will be called the statutory deductions. From this 1,20,000, if you exclude the statutory deductions, we will be getting net earnings. Let me take an example. Statutory deductions is 25,000. Statutory deductions is 25,000. 1,20,000 minus 25,000, 95,000 is the net earnings of the worker. Now what we need to understand is cost to company. CTC stands for cost to company. Apart from this 1,20,000, what is happening here? 1,20,000 is the total earnings. In that 1,20,000, 25,000 rupees has been paid to the respective departments: income tax department, PF department, ESI department, PT department. It is making payment by the company on behalf of the worker. Totally 25,000 paid. 95,000 rupees has been credited to the employee account. 95,000 rupees has been credited to the employee account. Totally 1,20,000 paid. Apart from this 1,20,000, the company management, MD of the company or management of the company has to contribute towards ESI and number 2 EPF. Simply I can tell you PF and ESI, employer contribution. This is called employer contribution. This is the employer contribution. Say how much is the employer contribution means it is normally equal to the employee contribution. Let me take an example. PF contributed is 2,000 rupees and ESI contributed is 3,000 rupees. Then here also ESI is 2,000 rupees. PF is okay. ESI is 2,000 rupees. PF is 3,000. Totally 5,000 rupees has to contribute by the employer. This is the employee contribution. This is the employer contribution. Now, what is the total cost to company? 1,25,000. 1,20,000 plus 5,000, 1,25,000. So 1,25,000 is the CTC, 1,20,000 is the total earnings, 95,000 is the net earnings. This you need to understand. If they ask to calculate worker earnings, if they ask to calculate worker earnings, you need to calculate 1,20,000. If they ask to calculate take home, then you need to calculate 95,000. If they ask to calculate employee cost, then we need to calculate 1,25,000. I hope everyone understand. Everyone got the clarity on this. I am proceeding into the question. Look at the question number 2. That is question number 9. I am sorry, question number 9. This is based on the valuation of the employee cost. Look at the question. P and Q are part of a manufacturing team that handles multiple jobs within the production process. Detailed description of their respective monthly wages is provided below. Fine. The standard working hours for the month are 210. Overtime is compensated at twice the sum of basic wages and dearness allowances. So when it comes to overtime, the payment will be double. Compared to normal time. Okay. Now that is how to calculate the twice of the sum of basic wages and dearness allowances. Fine. The employer's contribution to employer contribution to state insurance and provident fund are equal to the employee's contribution. Employees P and Q were assigned to job A, S and D in the following proportions. Fine. So here what we need to understand two things. Number 1, standard time is 210 hours. Number 2, they are going to get the twice the for the overtime they are going to get the twice the double time payment compared to normal time. That is second point. Third point is employer contribution is equal to the employee contribution towards PF and ESI. And then they mention they are working on the 3 jobs A, S, D. Okay, now look at here. Particulars PQ. Basic wages, dearness allowances given. We need to make total of these two. We'll be calling it as gross earnings. Because no other allowance is given. No bonus, nothing. Apart from this, they given the overtime condition. I'll tell you that. As of now, they given both basic wages and dearness allowances. We need to make total of that. Okay. Now look at here. See, no other allowance is given. So that I'm taking only both. Okay. Next. Contribution to provident fund and basic wages. Basic wage is this. On this, we need to calculate 10%. Contribution to employee state insurance on basic wages. That is 1.75% on the basic wages. If you exclude these two, we'll be getting net earnings. If you exclude those two, we'll be getting net earnings. Okay, next. Overtime hours is 8. P is working for overtime. See, the ditto question, same type of question is there in the study material also. Okay. Now, overtime hours is 8 hours. Now, what we need to do? For overtime hours, how to calculate? They mentioned basic wages plus dearness allowances, double time of this. So, total of basic wages plus dearness allowances divided by 210 hours, we'll get the hourly rate. Into 2, we'll get double time of the hourly rate. Into 2 will get the double time of the hourly rate. Are you understanding? Okay. Now, so gross earnings, net earnings. Gross earnings include basic wages, DNS services, and overtime wages also. And overtime wages also. Okay. Next. Now, job ASD. P is working. P is contributing 30% towards job A, 30% towards job S, 40% towards job D. Q is contributing 30% towards A, 50% towards S, 20% towards D. Clear? Now, overtime was done on job S. See, this 8 hours working by P, 8 hours working by P has worked for the job S. Okay, next. You are required to calculate earnings. Earnings means basic wages plus DNS allowances plus overtime wages. Okay, of P and Q. And allocate employee cost to each job ASD. Employee cost means gross earnings plus employer contribution to PF and ESI. This is equal to employee contribution to PF and ESI. Make total of this, will get employee cost. Then allocate to ASD in the given proportion. Are you understanding? And one more thing. Okay, let me explain with the help of solution. Look at here. First, statement showing earnings of worker P and Q. Basic wages 12,000, 15,000. DNS allowances 50%. DNS allowances 50%. See, 50% of basic wages. In the options of information, DNS allowances is always based on the basic wages. So 50% of basic wages, 6,000, 7,500. And overtime wages, how to calculate that? Listen to me carefully. Basic wages 12,000 rupees. DNS allowances, I am looking it for P. 6,000 rupees divided by 210 will get hourly rate, into 2 will get overtime rate. Look at here. 12,000 12,000 plus 6,000 divided by 210 equals to, this is the rate, into 2 double time. So 171.428, 171.428 into how many hours he is working? 8 hours. Into 8 hours will get 1371.42. 1371 is the overtime wages. Clear? Now, total earnings 19,371, 22,500 minus PF ESI of employee, minus PF ESI of employee will get net earnings. No TDS information, no PT information, no need to consider that. Whatever the information provided in the question, accordingly we are going to present the solution. Okay, now look at here. Contribution to PF 10% of basic, and here it is 1.75% of basic. So if we exclude both, we'll get 17,961 and 20,737. This is the net wages earned. Clear about this? Now, we need to calculate employee cost. How to calculate employee cost? To the gross wages earned. To the gross wages earned, we need to add same amounts, which is called as employer contribution. Look at here, employer contribution. If you add the same amounts, 19,371, 22,500. And one more thing, excluding overtime. Why we are excluding overtime is because overtime is specifically worked on job S. Overtime is specifically worked on job S. Whereas this 19,410, 24,263 has to be apportioned between A, S, D. Please understand, overtime is only for S. When it comes to these two amounts, has to be apportioned for A, S, D. Job A, job S, job D. They given the proportion 30, 30, 40. Nothing but 3 is to 3 is to 4. 30, 50, 20. Nothing but 3 is to 5 is to 2. Okay, now look at here. 3 is to 3 is to 4. 19,410. They apportion the amount. And overtime is specifically given to S. Overtime is specifically given to S. And then ordinary wages 3 is to 5 is to 2. Total amount is 24,263. After allocation, if you make a total, cost allocated to job A is 13,102, job S 19,325, job D 12,617. This is the apportionment of employee cost. All of you clear about this? Okay, next. Next question is from the overheads. In this question, in this question, it's about entire process of primary. There is no primary distribution, but there is a secondary distribution. Secondary distribution and then absorption and then presentation of the cost sheet. Not a cost sheet, cost of the each product. Okay, the point is number one, we need to do the secondary distribution. We all know that secondary distribution means apportioning service department cost to the production department. After doing that, service departments will become zero. Entire cost accumulates in the production department. From the production department, we are going to charge it to the products. We are going to charge it to the finished products. Look at the question. Very simple question. Just we need to understand the information. Now look at here. There are two products, X and Y. There are two production departments, P1, P2. There are two service departments, S1, S2. P1, P2, S1, S2. Two products, two production department, two service department. Clear? Next. Predetermined overhead rates are applied in the production department to allocate factory overhead cost to the product. We already know this. We all know about this. Whenever we are absorbing the overheads, absorb the overheads always using budgeted rate. Absorb the overheads always using budgeted rate. We will never use the actual rate. Why? Because we don't know the actual rate. We don't know the actual rate. When we will get to know the actual rate? At the end of the period. We don't know the actual rate at the beginning, so that we are using the budgeted rate. Okay, next. The rate for department P1 is determined based on direct machine hours. That means P1 department is based on machine hours, P2 department is based on labor hours. There are two different base quantities. P1 based on machine hours, P2 based on labor hours. Okay, next. A technical assessment of the apportionment of expenses of service department is as under. Now listen to me. This is about apportionment of service department. Apportionment of This is about apportionment of service department cost. S1 department will be apportioned in the proportion of 3:3 to the P1 and P2. S2 department will be apportioned in the proportion of 30:15 to P1 and P2. Whatever the cost in S1, that will be apportioned to P1 and P2. Whatever the cost in S2, that will be apportioned to P1 and P2. Next. Following budgeted data. This is the budgeted data. Following budgeted data is available. Factory overheads for the year. P1 2 crore 80 lakh 50,000, P2 2 crore 39 lakh 25,000, S1 66 lakhs, S2 49 lakh 50,000. These all are the budgeted data. Okay, next. Details relating to production of product X and Y is as follows. X, how many units? 1 lakh units. Y, 60,000 units. Budgeted raw material cost per unit. All materials are used in P1 only. 660 rupees, 825. This is the budgeted material cost. Next. Budgeted time required for production per unit. Listen to me carefully. P1 is all about machine hours. P2 is about labor hours. So when you calculate the labor cost, we require the labor hours. In P2 department, product X is consuming how many hours? 2 direct hours. In P2 department, product Y is consuming 2.5 labor hours. So total labor hours required for product X is 2. For product Y, it is 2.5 hours. Labor rate is 396, 412.50. Are you understanding? All of you? Okay, next. Following actual data is available. This is the actual information. Following actual data is available for the month of December 2024. So when it comes to actual data, how many? See, product X, 8,000 units, product Y, 6,000 units. And one more thing, for the month of December 2024, when it comes to here, for the year, this is the yearly information, this is monthly information. Be careful. Actual is in terms of month, budget is in terms of year. Okay. In a 1 month time, X is producing 8,000 units, product Y, they are producing 6,000 units. Actual hours worked for production. In P1 department, total machine hours is 12,200, 8,300. In P2 department, labor hours is 16,400, 14,800, 14,800 direct labor hours. And raw material cost given, wage cost given. These are the totals. Okay, next. All factory overheads incurred is as follows. P1, P2, S1, S2 given. Now, compute predetermined overhead rate. Compute predetermined overhead rate. Nothing but budgeted rate. How to calculate budgeted rate? budgeted overheads divided by budgeted base quantity. Budgeted base quantity. To calculate budgeted overheads, they given P1, P2, S1, S2. First what we need to do, S1 and S2, we need to apportion back to P1 and P2. Then we will get the total of P1 department, total of P2 department. Divided by P1 department is based on machine hours, P2 department is based on laborers. We need to know budgeted machine hours. What are the budgeted machine hours? Listen. First, let me take the budgeted machine hours. See, product X is taking 1.5 mission hours into how many units? 1 lakh units. So 1.5 into 1 lakh, 1,50,000. And product Y is taking 1 mission hour, 1 into 1 lakh, 1 lakh. Totally mission hours is 2,50,000 mission hours. Next, P2 department is department labor hours. 2 into 1 lakh, 2 lakh. Sorry, 2 into 1 lakh, 2 lakhs. Here it is not 1 lakh, I think. I'm sorry. 1 into how many units? 60,000. 1 into 60,000, 60,000. 1 into 60,000, 60,000. 1 lakh 50,000 plus 60,000, 2 lakh 10,000 mission hours. 2 lakh 10,000 mission hours. When it comes to labor hours, 2 into 1 lakh, 2 lakh, 2.5 into 60,000. That is 1 lakh 50,000. Totally comes to 3 lakh 50,000 labor hours. 3 lakh 50,000 labor hours. So this is the machine hours and this is the labor hours. Using that, we can calculate the budgeted rate. Okay, listen to me carefully. Look at here. First, let me apportion. Let us apportion service department cost to production department. Let us apportion service department cost to production department. See, computation of predetermined rate. Look at the question. Please look at the question. Budgeted overheads given in the question. P1 2 crore 80 lakh 50,000. P2 2 crore 39 lakh 25,000. S1 66 lakhs. S2 49 lakh 50,000. Same thing has been taken here. S1 department 66 lakh rupees will be apportioned to P1 and P2 in the proportion of 3:3. In the proportion of 3:3. So 33 lakhs, 33 lakhs. S2 department 49 lakh 50,000 will be apportioned in the proportion of 30:15, nothing but 2:1. 2:1. 33 lakh 16 lakh 50,000. Total is 3 crore 46 lakh 50,000. 2 crore 88 lakh 75,000. That is the total. Okay, that is about P1 and P2. Now 2 lakh 10,000 hours, 3 lakh 50,000 hours. Just now I explained how to get this. So if you divide that, we'll get 165.82.5. This is the budgeted rate. Okay, to be so precise, this I am going to call it as budgeted mission rate or mission hour rate, budgeted labor hour rate. This is budgeted mission hour rate and this is budgeted labor hour rate. By this we done with the first requirement. Look at the second requirement. What is the second requirement? They are asking, prepare a comprehensive statement reflecting budgeted cost and actual cost for production of product X and Y during the month of December 2024. They are asking budget and actual of product X and Y. The only mistake here in the presentation is they taken budget and actual, okay, but it would have been a better presentation if they would have taken X and Y separate. If they would have taken X and Y separately, X budget actual, Y budget actual, it would have been a better presentation. But what they did, they taken budgeted information, actual information. First they written X values and then they written Y values. First, material. Look at the question. Material. They given the actual of X. How much is the actual of X? 53 lakh 79,000 and actual of Y 50 lakh 16,000. 50 lakh 16,000 directly given in the question. Now budget. When it comes to budget, we need to calculate. Here they given budgeted raw material cost per unit 660. So 660 into how many units? 1 lakh units. You will be getting 6 crore 60 lakhs. Sorry. That is 1 lakh units. One more thing. Actual is per month we taken. Budget also should be per month. Budget also we have to take it per month. Actually, how many units they produce in a month? 8,000 units. So 8,000 units into 660 rupees. 8,000 units into 660 rupees. Are you understanding? Comparative statement. If you are taking actual for 8,000, budget also should be for 8,000 units. So 8,000 units into budgeted material cost per unit is 660 rupees. So 8,000 into 660, 52 lakh 80,000. Next, Y 8,000 into 825. 8,000 into sorry, why how many units they are planning to produce? 6,000. I'm sorry, 6,000. So 6,000 into 825. That is 49 lakh 50,000. This is the budget. Same way labor cost. Labor cost actual is given directly. How much is the actual? 65 lakh 10,900 for X, 62 lakh 60 lakh 72,000 for Y. 65 lakh 10,900, 60 lakh 72,000. When it comes to labor cost per unit or per sorry average wage rate budgeted in department P2, 396 per hour. 396 per hour. So what we need to do? 8,000 units into in P2 department. How many hours it is consuming? Product X 2 hours. So 8,000 into 2 into 396. 8,000 uh, 8,000 into 2 into 396. 63 lakh 36,000. When it comes to Y, 6,000 units. And how many hours it is taken? 2.5 hours. So 6,000 into 2.5 into 412.50, you'll be getting 61 lakh 87,500. This is about labor cost. If you make a total of these two, you'll get prime cost. Prime cost they didn't show. Okay, fine. That's fine. Now it's about overheads absorption. Overheads absorption from P1 department, overheads absorption from P2 department. P1 department is using machine hour rate, P2 department is using labor hour rate, which we already calculated in the first requirement. Okay, now let me discuss about P1. P1 is based on mission hours. Okay, actuals is also not given. Actuals is also not given. We need to calculate the actual also. Please understand when it comes to overheads, budget is using budgeted rate, actuals is using actual rate. Actual rate that they given in the question? Absolutely no. They given the production department, service department, actual factory overhead incurred. Production department, service department given. Now what we need to do? Service department cost should be opposite to production department. Then using the actual overheads, we need to calculate the actual rate. Okay, and then the actual hours given. Look at there. Actual hours worked for production. X department P1 12,200. Y department 8,300. If you make a total, you'll get 20,500 machine hours. Labor hours is X, product X 16,400, product Y 14,800. If you make a total 31,200. We know the actual hours, we know the actual overheads, calculate the actual rate. Here they give the working. See 20,500, 31,200 actual hours. Okay, this is actual machine hours, this is actual labor hours. So here we take the actual. This is the actual overhead rates. Look at the page number 14. Look at the page number 14 in RTP. Actual overheads. First, what we are doing 6,60,000. We are apportioning back to P1 and P2, and 5,28,000. We are apportioning to P1 and P2 in the proportion of 2:1. Here it is 1:1. Okay, we get total. Divided by hours, we'll get actual rate. Are you understanding? While calculating in the actual column, take the actual rate. While calculating the budget column, take the budgeted rate. Okay, look at here. Overheads of P1 department. P1 department is based on mission hours. X product X. How many units we are producing? 8,000 units into. Look at the question. How many mission hours they are taking? 1.5. So 8,000 into 1.5, 12,000. 12,000 into budgeted rate. 12,000 into budgeted rate 165. 190 like 80,000. And actually is 157.22. Here they shown the calculation. Look at here. Here they given. Actually is 12,200 into 157.22, 8,300 into 157.22, 19,000, 19 lakh 18,084, 13 lakh 4,926. This is the actual. This is the actual and this is the budget. Same way, labor hours. 8,000 into 2, 82.5, 6,000 into 2.5, 82.5. We'll get the budget. Actuals is based on the actual. Actual hours is how many hours? Product X is taking 16,400 hours. Product Y is taking 14,800 hours. And hourly rate is 88.14. Hourly rate is 88.14. Look at here. Where is the calculation? Here it is. 88.14. They get the amounts. Okay. So that is about overheads. So this is about cost comparison between product X and product Y. Clear? Now, calculate the amount of under or over absorption of production overheads. How to calculate under or over absorption? Absorbed overheads minus actual overheads. Absorbed overheads minus actual overheads. Here, whatever we shown, cut. Here, whatever we shown, it is the absorbed overheads, and this is the actual overheads. Okay, look at here. Same amounts has been taken here. Okay, now listen to me carefully. This is the absorbed. This is the absorbed. This is the actual. Absorbed is 19 lakh 80,000. Here it is 19 lakh 18,000 over absorption. Over absorption of 61,916. Product Y 9 lakh 90,000, 13 lakh 4,926. This is under absorption. Under absorption by 3 lakh 14,926. Difference between these two. Next, 13 lakh 20,000, 14 lakh 45,496. Under absorption or over absorption? Under absorption or over absorption? It is under absorption. 12 lakh 37,500 minus 13 lakh 4,472. This is also under absorption. Okay. So this is about the overhead structure. Are you understanding? All of you? Okay. Okay. I hope you all know the format of the cost sheet. Next question is using the concept of cost sheet. What is the format of cost sheet? It's very simple. First, we will calculate direct material consumed. How to calculate direct material consumed? Opening stock of raw material plus purchase of raw material plus carriage inward minus purchase returns minus closing stock of raw material minus scrap income of raw material. If you adjust these six elements, see, first three adjustments should be added, next three adjustments should be reduced. What are the three adjustments to be added? Opening stock of raw material plus purchase of raw material plus freight inward. These three items to be added. What is to be reduced? Purchase returns, closing stock of raw material minus scrap income of the raw material. If you adjust these six elements, we'll be getting direct material consumed. Add direct wages, direct expenses, we'll be getting prime cost. Add production overheads, we'll be getting gross works cost. Add opening WAP less closing WAP, we'll get net works cost. Add quality control cost, research and development. These are the manufacturing related costs. These things are the manufacturing related costs. Quality control cost, research and development cost, administration overhead related to production minus scrap income or salvage income plus primary packing cost. If you adjust these five elements, we'll be getting cost of production. Add opening stock of finished goods less closing stock of finished goods, we'll be getting cost of goods sold. Add administration overhead general, add selling and distribution overheads, add secondary packing cost. We'll be getting cost of sales. Add profit, we'll be getting sales. This is the format of the cost sheet. Now look at the information given in the question. What is the information given? Just let us classify under what head we are going to consider. Listen. The figures listed below are derived from the trial balance of EVS and company as of 31st March. What are the figures given? Opening inventory is given. First they given finished goods, raw material, work in progress. Office appliances, plant and machinery, land and building. These things are the fixed assets. Using this, we need to calculate depreciation. Depreciation of office appliances is administration overhead general. Depreciation of plant and machinery is factory overheads. Depreciation of building is factory overheads. If they mention any adjustment, we'll adjust that. Next. Sales. At last, we are going to consider at the end we are going to consider the sales returns and rebate, so that we need to adjust cash discount allowed on sales. No need to adjust this. It will not form part of the cost sheet. Okay, now cash discount, it will not form part of the cost sheet. It is financing item. In cost sheet, we can say only operating activities. Non-operating activities will not form part of the cost sheet, so no need to consider this. From the sales, we are going to reduce the sales return and rebates. Okay, material purchased, it helps to calculate direct material consumed. Next, freight inward, direct material consumed. Purchase returns, direct material consumed. Direct employee cost, direct wages. Indirect employee cost, production overhead. Indirect employee cost, production overheads. Drawing and design cost, production overheads. Repairs and maintenance of factory, production overheads. Heat, light and power expenses, production overheads. There is one more adjustment based on this, we'll consider that later. Next, pollution control expenses, production overheads. Sales commission, selling and distribution overhead. Sales promotion, selling and distribution overheads. distribution department salaries and expenses, selling and distribution overheads, office salaries and expenses, administration overhead general, packing cost to make the product marketable. See, please understand there are two types, okay, three types of packing: primary, secondary, special secondary. Primary packing will help to carry the goods. Without the primary packing, product will not be in existence. Example, toothpaste tube, all covers, all the covers which are used for packing, all the primary packing, all cardboard boxes which are they used in the secondary packing. Okay, so primary packing is just to carry the product, secondary packing is to promote the product. Okay, look at here, product marketable. So it is a secondary packing, selling and distribution. It will form part of selling and distribution. Primary packing, we have a separate column for that. Other manufacturing related expenses. Okay, next. Printing and stationery expenses, administration overhead general, bank charges paid, administration overhead general. Okay, next. Closing inventories, finished goods, raw material, work in progress. Outstanding direct employee cost 1,09,600. It will be forming part of direct wages. Cost sheet will be prepared on accrual basis. Cost sheet will be prepared on accrual basis. So it will be forming part of direct wages. Depreciation, I told you. There they given the asset value. Use these percentages, calculate the depreciation. Next, 70% of the heat, light, power expenses is related to factory, and remaining 30% is equally shared between office and selling department. So, heat, light, power cost. How much is that? Totally 8,90,500. 8 lakh 9,000 or 90,000? 8,90,500. Okay. 8 lakh, sorry. 8,90,500. 8,90,500. Out of this, 70% belongs to factory, balance 30% belongs to both admin and selling. This equally we need to apportion. Okay, so accordingly we can calculate that. Next, depreciation of building is to be distributed at similar percentage. Look at here, building 10%. What is the total building value? Total building value is 27,40,000. 27,40,000. 2 lakh 74,000. This we need to divide between 70% factory, 30% to both admin and selling. That is what they stated here. Depreciation on building is to be distributed at a similar percentage between factory, office, and selling and distribution department as that of heat, light, and power. As how we distribute the heat, light, and power, same way we need to distribute the depreciation on building. Are you understanding? Okay, next. With the help of the above information, you are required to prepare a condensed profit and loss statement of EVS and company for the year ended 31st March along with the following schedules. So, what are the schedules that they are asking? Cost of sales, showing prime cost, transfer cost, cost of production, cost of goods, so cost of sales. Nothing but cost sheet. What they are asking is cost sheet. What they are asking is cost sheet. To prepare this cost sheet, we require selling and distribution expenses schedule and administration expenses schedule. I already clearly mentioned here what is forming part of administration. Just put it into one statement which is called administration expenses. All selling and distribution in one more statement which is called selling and distribution. And we know the format of cost sheet. Accordingly, we can present. It is not that complication. So please manage yourself and try to present as per the solution given in the article. Okay, next. It is not that complicated. I don't want to waste time on that. Fine. Next. Cost accounting system. Look at the question. Cost accounting system. Look at here. AMI Limited uses batch costing system that is fully integrated with its financial books. Listen, listen, listen. Integrated. Now we need to follow the integrated system. Fully integrated with its financial accounts. Balances at beginning of the period is provided. So here we are going to prepare the books on integrated system. So under integrated system, are we going to have CLC or GLA account? Absolutely no. In place of CLC and GLA, we are going to place with the respect to financial ledger. We are going to place with the respect to financial ledger because we are following the integrated system. GLA will come only non-integrated system. Are you understanding? Okay, now look at here. This is the opening balances. This is the opening balances given. Next, they given Other information is as under materials purchased during the period. I already uploaded the video based on the cost accounting system. If you have any doubt regarding the journal entries, please watch the video. You'll get the full clarity. It's my guarantee. 100% you'll get the clarity. I clearly explain what is the entries related to material, entries related to labor, entries related to overheads, and how to close the accounts. Everything I have clearly explained. You can just go through the video. Next, material purchase during the period. And one more thing, if you are watching this video, please subscribe my channel. Many students are watching the videos and they are not subscribing. If you look into my channel, the percentage of watching is by the major portion is by the unsubscribed people. Subscribed people are watching less, but unsubscribed people are watching more. Our request is that please subscribe my channel. It is a just it's a add-on. I can say like it's the boost. It is the boost which is given to me. Are you understanding? Please subscribe. If you are not yet subscribed, please subscribe my channel. Next, material purchased during the period. What is the entry for this? What is the which account to be debited? SLC account debit. SLC account debit. 2. See, purchased during the period. They didn't mention whether it is credit or cash. So SLC account debit to cash or creditor. Okay. Next, material issued to production. Issued from where? Issued from the storeroom to the production means factory. Factory denoted by AAP. So from SLC we are transferring it to AAP. So AAP account debit to SLC account. That is the entry. Sorry, that is the entry. Next, total wages paid. When it comes to wages, there are two entries: payment entry, utilization entry. What is the payment entry? Wages control account debit to cash. Utilization. What is the utilization entry? If the payment is made to the direct workers, we will debit WAP account. If the payment is made to indirect workers, we will debit the production overhead. If the payment is made to administration staff, debit the administration overhead. If the payment is made to selling and distribution staff, debit the selling and distribution overhead. If the payment is made for abnormal idle time, debit abnormal loss account to wages control account. Okay, now total wages paid 5,79,900. So the entry for this is wages control account debit to cash or bank. Next, direct wages charged to batches. Direct wages charged to batches. That means accounted to batches. Here they are following batch costing system. So that means charges to batches in the sense added to the products. Added to the products or payment to the direct workers. Or we can call it as payment to the direct workers. So which account to be debited? WIP account. Which account to be debited? WIP account. Next, payment of non-productive time of direct workers. So please understand here slightly confusion. I am telling you very clearly. Please explain carefully. Now look at here. Payment for non-productive time. What do you mean by non-productive time? Idle time. When it is for idle time, abnormal loss. One more thing. When it comes to ideal time, two types of ideal time is possible: normal ideal time, abnormal ideal time. In this point, anywhere they specify is it normal or abnormal? Has they specified normal, abnormal? Abnormal means directly transfer to abnormal loss account, and from there will transfer to the costing period. But in this question, nothing has been specified. But Institute has taken it as a normal ideal time. Institute has taken it as a normal ideal time. Institute has taken it as a normal ideal time. Are you understanding? If it is for normal ideal time, labor normal ideal time, it will be transferred to factory overheads. Normal ideal time will be transferred to factory overheads. Are you understanding? All of you. Okay, now. Production overheads incurred. This will be transferred to production overheads. Treating it as normal ideal time. Treating it as normal ideal time. Next. Production overheads incurred 2,31,960. What is the entry? Production overhead account debit to cash. Production overhead account debit to cash. Sales. What is the entry for sales? CLC. Okay. Cash account debit. Cash account debit to costing P&L. Cash account debit to costing P&L. Okay. Cost of finished goods sold. Cost of finished goods sold. What is the entry? Cost of sales to finished goods or cost of goods sold to finished goods. If you pass the entry cost of goods sold to finished goods, and then this cost of goods sold will transfer to cost of sales. So directly you can write the entry cost of sales to finished goods. Next, cost of goods completed and transferred into finished good during the period. Completion of goods. So once it gets completed, from work in progress, we transfer it to finished goods account. So the entry is finished goods account debit to work in progress. Finished goods account debit to work in progress. Next, physical value of work in progress at the end of the period 7,73,200. So please understand, physical value means according to the valuation rules. They would have valued according to the valuation rules. The value comes to 7,73,200. Are you understanding? Normally, WAP should be valued according to percentage of completion. That is one way of doing. Another way of doing is comparing with the market. Okay, physical value. So at present, the value of the stock is 7,73,200. 7,73,200. Okay, fine. Next, production overhead absorption rate. 130% of direct wages charged to work in progress. So what is the wages charged to work in progress? Look at here, 3,86,600. Direct wages charged to WAP is 3,86,600. On that 130% is the absorption. What is the production overheads absorption entry? What is the production overheads absorption entry? WAP account debit to production overheads. Entry is WAP account debit to production overheads. What is the absorption entry for administration overhead related to production? Finished goods to administration overheads. What is the absorption entry for administration overhead? General cost of sales to administration overheads. What is the absorption entry for selling and distribution overhead? Cost of sales to selling and distribution overheads. So here it is production overheads absorption, WAP account debit to production overhead account. So this is the entries. These are the entries. You by passing all these entries, they are asking stores ledger control account, wages control account, production overhead control account, work in progress control account, finished goods control account, costing, P&L account. Okay, now okay. Let us solve this question. Now look at the solution. Yeah. See generally how to solve this. First, we'll write the opening balances. What is the first opening balance given? Stores ledger control account 4,83,250. Generally, stores ledger work in progress finished goods will be having the debit balances. Will be having the debit balances. So I'm going to open these three ledgers. Stores ledger control account opening balance 4,83,250. 4,83,250. Next, work in progress control account. Work in progress control account opening balance 3,86,600. Finished goods control account 6,76,550. So just I have written the opening balances. Just I have written the opening balances. Okay, next. What is the first transaction given? Material purchased during the period. What is the entry for this? What is the entry for this? SLC account debit. SLC account debit to cash. Because here they didn't mention whether it is cash purchases or credit purchases. And one more thing, we are under the integrated system. We are under the integrated system. So SLC account debit to cash or creditor. Go to the SLC account. Go to the SLC account. SLC account debit to creditors or bank. Creditors or bank 14,49,750. We no need to prepare the creditors account or bank account. So there is no corresponding there is no corresponding adjustment. There is no corresponding adjustment for this entry. Okay, next. Material issued to production. What is the entry for this? Work in progress account debit to SLC account. Work in progress account debit to SLC account. In SLC account, we will write by work in progress 5,79,900. In work in progress, we will write to SLC account 5,79,900. Are you clear on this? Next, total wages paid. First, we have to write the payment entry. What is the payment entry? Wages control account debit to bank. Wages control account debit to bank. 5,79,900. 5,79,900. Okay, next. 1/6 being indirect. Let us understand this. Please understand. Whenever it comes to wages, there are two types: direct wages, indirect wages. In this question, they clearly mentioned indirect wages is 1/6. So 5,79,900. 5,79,900 divided by 6, that is 1/6, equal to 96,650. 96,650 is indirect. 96,650 is indirect. Okay, then how much is direct? 5,79,900 equal to 4,83,250. 4,83,250 is direct. Okay, now, so here we written to production. Indirect wages will be transferred to production overheads. Direct wages will be transferred to work in progress. But one small adjustment in this question is below that they given direct wages charged to batches. Out of this, how much has been charged to batches? How much is charged to batches? 3,86,600. 3,86,600. Then what is the balance amount? 96,650. Are you understanding? Okay, here clearly mentioned payment for non-productive time of direct worker. Non-productive time, nothing but ideal time. Non-productive time, nothing but ideal time. Ideal time can be of two types: normal ideal time, abnormal ideal time. If it is abnormal ideal time, we will transfer it to P&L account. If it is normal ideal time, we will be transferred to production overhead account. If it is normal ideal time, we will charge it to production overhead account to recover it from the customers. To recover it from the customer, we charge it to production overheads. So what I mean to say, this 3,86,600 has been charged to the batches. So we are going to account it to work in progress. It has been accounted to batches, so we are going to account it to work in progress. Next, 96,650, we are going to charge it to factory overheads. Are you understanding? Here, what they mentioned, non-productive downtime is 1/5 of direct wages paid. Total direct wages paid is 4,83,250. 4,83,250 on that 1/5, which is 96,650. The 96,650 will be charged to factory overheads, whereas 3,86,600 will be accounted to work in progress. So finally, what is happening? Work in progress 3,86,600, production overhead control account indirect wages 96,650, production overhead control account non-productive time 96,650. This is about wages control account. Next, what they mentioned, sales 19,33,000. So what is the entry for the sales? Bank account debit to costing P&L account. Bank account debit to costing P&L account. Bank account debit to costing P&L account. So they written by sales. Here they can write by bank also, but they written sales account 19,33,000. Are you understanding? Next, what is the entry? Cost of finishing goods sold. What is the entry for the cost of finishing goods sold? Normally, we'll write the entry cost of sales to finished goods. Cost of sales to finished goods. In this case, no need to prepare the cost of sales account. Even if you transfer it to cost of sales account, from there we'll transfer it to costing P&L account. So directly you can write the entry costing P&L account debit to finished goods. So to finished goods, 15,46,400. Are you understanding? Next, cost of goods completed and transferred to finished good during the period. Goods get completed. Once the goods get completed from work in progress, we'll transfer it to finished goods. So what is the entry? Finished goods account debit to work in progress. So finished goods account debit to work in progress 12,56,450, and in work in progress by finished goods 12,56,450. Clear? Next, physical value of work in process at the end of the period. That is the closing stock of the work in progress 7,73,200. Next, production overheads absorbed. Production overheads absorbed. I clearly explained we are going to debit into work in progress. 130% of direct wages charged to work in progress. How much is the amount charged to work in progress? 3,86,650. Sorry, 3,86,600 into 130%. 3,86,600 into 130% equals to 5,02,580. 5,02,580 is the amount. There is the absorption, work in progress to production overheads. If you look at the production overheads account, work in progress to production overhead 5,02,580, and here 96,000. So first of all, production overhead incurred 2,31,960. I missed out that entry. Production overhead incurred. What is the entry? Production overhead account debit to bank. To bank 2,31,960. From here, we are taking totally 1,93,300. If you sum up these two, you will get 1,93,300. So by this we pass the entry for all the transactions. Now let us tally one by one. First we are tallying stores ledger control account. We know the opening balance. We know the opening balance. We know these two entries. The closing balance is 13,53,100. That is the balance carried down. Okay. Next, when it comes to wages control account, it will get automatically tallied. When it comes to production overhead control account, there is a over absorption. See, I already told you. Debit is always incurred. Debit is incurred. Credit is absorbed. Credit is absorbed. Absorption is 5,02,580, whereas debit is less than that. So 77,320 is the over absorption. Incurrence is less, absorption is more. Absorption is more, incurrence is less. So it is over absorption. It is over absorption. Over absorption by how much? 77,320. That over absorption will be transferred to P&L account. Are you understanding? Okay. So they transfer it to P&L account. In P&L account, 77,320. Next, look at the work in progress control account. Here, work in progress control account. See, wages control account, production overhead control account. Here it is corresponding entry. Corresponding entry of these two. So we know the opening balance, we know the closing balance, we know the material, labor, overheads, and finished goods given. All the entries have been given. There is still some balance left out, that is 1,73,970, which is the stock gain. Generally, we'll be calling it as stock valuation, stock adjustment. In accounting, in financial accounting, we'll be calling it as stock adjustment. Because of physical valuation of the work in progress, some gain has been arrived. That gain will be transferred to P&L account, costing P&L account. Okay, 1,73,970. In costing P&L will write 1,73,970. And then we'll take the, okay, finished goods control account. Here we already written this entry. Fine. Now this is the balance figure. This is the balance figure. And when it comes to costing P&L account, we are taking the balance carried down 6,73,000. Sorry, 6,37,890. We can call it as net profit. We can call it as net profit or costing profit. We can call it as costing profit. So this is how we need to prepare ledgers for this respective question. Okay, now let us start with the question from the joint and batch costing. Sorry, job and batch costing. Okay, let us read the question. Look at the question. Job and batch costing. This question is ditto similar to the study material question. It is similar, exactly similar to the study material question. So, okay, now look at this. X Limited provides the following cost details for calculating the selling price of job number X to X. So, how they calculate the selling price? They taken the material 1,330, direct wages 855. When it comes to direct wages, totally 18 hours. Such 18 hours taken from department X, department Y, department Z. If you make a total 8 plus 6 plus 4, you'll get 18. Each hour is paid at the rate of 47.50, so you'll get 855. Next, chargeable expenses 95 and one third of expenses cost 760. Totally, they made a total cost. Total cost comes to 3,040. This is how they arrived at the cost of the job X to X. Now, what they given? Analysis of profit and loss account of the company. Analysis of profit and loss account of the company for the current financial year. They given the sales. What are the cost details given? Number one, they given the material, and then they given the direct wages, department wise, department X, department Y, department Z, direct wages given. Special stores 76,000 and overheads given department wise. Works cost comes to 38 lakhs. Gross profit taken. Selling expenses 3,80,000. From the gross profit, they reduced the selling expenses so that they got the net profit of 5,70,000. It is also noted that average hourly rate for the three departments X, Y, and Z are similar. Average hourly rate. Okay. You are required to prepare job cost sheet to determine the selling price by calculating the entire revised cost using above figures as the base and adding 20% to the total cost. First of all, we need to understand what is job cost sheet. See, normally cost sheet, what we'll prepare in the cost sheet chapter is that is for overall company. There are companies which will be following job costing system and unit costing system. The cost sheet what we prepare is based on unit costing system. Unit costing system. There we take 10,000 units, 20,000 units. For 20,000 units, we prepare the cost sheet, which is based on the unit costing system. But when it comes to job costing system, it is for one single job. We are going to prepare the cost sheet for the one single job. When we are preparing the cost sheet for the one single job, there will be no opening stock, closing stock information because we are doing it for one job. For the respective job, how much is the material, how much is the labor, how much is the overheads, how much is the profit expected. If you prepare a cost sheet for the one single job, that is called the job cost sheet. According to given information, how much is the direct material for the respective job? Direct material is 1,330. Direct material is 1,330. Here it is given. It is the time to add the wages. When it comes to wages, that is also given 855. Till here it is clear. Are you understanding? Now we need to add the direct expenses. Look at here. The only point which we need to be careful is absorption of overheads. The only point which we need to be careful is absorption of chargeable expenses 95 given. Now the point is absorption of overheads. How to absorb the overheads? Here if you look at the P&L account, they given department wise XYZ overheads and department wise labor cost. We can take the direct wages as the base. See, there are 6 different types of base quantities according to our syllabus. There are 6 different types of base quantities. What are the 6 different types of base quantities? Either you can use labor hours, machine hours, production units, material cost, labor cost, and then prime cost. According to given information, to absorb the overheads, which is supporting, wages is supporting, department-wise wages given and department-wise overheads given. No other information is available in department-wise. The only information available is direct wages. So I'll take direct wages as the base. What's wrong in that? If direct wages is the base, how to calculate absorption rate? Absorption rate equal to direct wages divided by, absorption rate equal to overheads divided by direct wages into 100. We'll get the percentage. Look at the X department. If you look at the X department absorption rate equal to overheads is 95,000 divided by 1,90,000 into 100, which equals to 50%. 50% of direct wages. Are you understanding? Now come to the respective job. If you look at the respective job, it is taking on department X 8 hours at the rate of 47.50. 8 into 47.5 equals to 380. 380 into 50% is the overheads, which equals to 190. Overheads is 190 from department X, like the department Y, department Z. Make a total. We'll get the total overheads. Are you understanding? We know material, labor, direct expenses. Now we know the overheads. If you make a total, we'll be calling it as cost of production. To the cost of production, we need to add. See, normally there will be no opening stock, no closing stock. Then cost of production is the cost of goods sold. To the cost of goods sold, we need to add administration overheads, selling and distribution overheads. If you look at the P&L, it is having only selling expenses. This is the only point which we need to remember, which you need to remember. Selling expenses in this question is absorbed based on work cost. Is absorbed based on the works cost. Works cost is 38 lakhs. So what they did, 3,80,000 divided by 38 lakhs into 100, 10%. 10% of works cost. Selling expenses 10% of works cost. Are you understanding? All of you? Okay, now look at the solution. Direct material 1330 given in the question. Direct wages department wise they calculated 380, 285, 190, 855. Chargeable expenses 95. Prime cost is 2,280. It's time to absorb overheads. When it comes to absorption of overheads, as I told you, they taken the direct wages as the base. Direct wages means 95,000 divided by 1,90,000. That is overheads divided by base quantity. Absorption rate equal to overhead divided by base quantity. Overhead is 95,000. Base quantity is 1,90,000. 50%. 50% of 380, 190. Like that, they calculate department Y. 1,71,000 is the overheads divided by 2,28,000 into 100. 75% of 285, 213.75. Department Z 47.50. If you make a total 451.25. This is the overheads. If you make a total of prime cost and overheads, if you add prime cost and overheads, you get normally works cost. We'll call it as works cost or cost of production. Works cost, which is also called as cost of production, which is also called as cost of goods sold, 2,731.25. To this, add the selling expenses by taking what? Works cost as the base. By taking works cost as the base. So 10% of works cost, 10% of works cost. So 10% of works cost is 273.13. Total cost comes to 3,004.38. And they clearly stated in the question to add the profit of 20%. To add the profit of 20% to the total cost. Okay, now 20% of total cost is 600.88. Selling price is 3,605.26. Are you understanding this? This is how we need to prepare the job cost sheet. The job cost sheet, what they prepared in the question is baseless. The job cost sheet, what they prepared in the question is baseless. So they given the existing job cost sheet and they're asking us to prepare the revised job cost sheet by giving the P&L. If you look at the P&L, we'll get to know what all the expense incurred in the factory and what is the expense that need to be charged to the respective job. All of you clear? Okay, so this is about job cost sheet. Let us start with the question from the process costing. We all know that when it comes to process costing, two types of questions possible: with stock, without stock. With stock, without stock, and there are two methods: FIFO, weighted average method. Let me talk about the with stock, without stock. If the question is without stock, there is no opening stock, there is no closing stock, then straight away we are going to prepare the process account. No need to go by the statement of equivalent unit, nothing like that. Straight away we can prepare the process account. In the presence of stock, if the stock is present, then first step is statement of equivalent units. Why? Because in process costing, when I say stock, it is all about work in progress, semi-completed. So there are two types of units: semi-completed, fully completed. So we are going to calculate the equivalent units. Once we calculate the equivalent units, then we'll calculate cost per equivalent unit, then we'll do the apportionment, then we'll prepare the process account. Let us look at the question. What is the information given? Let us look into the question. Process costing. Look at here. There is no much complication in this question, straightforward question, but only thing is we need to prepare process 1 and process 2. Most of the questions in the study material is they are asking only one process account, but in this they are asking two process accounts, so we have to go step by step. Listen to me carefully. Following data are available for product for the month of July 2024. Okay, now opening work in progress nil, cost incurred during the month. Material 6 lakh rupees, labor 1,20,000, factory overheads 2,40,000. Everything will be debited to the process account. Units produced, received in process 40,000, nothing but input, nothing but input. This is the material input. Received in, sorry, this is the material input. Next, completed and transferred. This is the completed units. Closing work in progress uncompleted 2,000. Normal loss in process 2,000. This is the normal loss. Okay. So 40,000 is the input and 40,000 is the output. When it comes to output, there are three categories: completed, uncompleted, loss, and they clearly specify normal loss. We all know the adjustment of the normal loss and abnormal loss. To the normal loss, we are not going to account the cost. To the abnormal loss, we'll account the cost and we'll transfer to P&L account. Normal loss cost will be adjusted by good units, will be loaded to the good units by using the formula total cost minus normal loss scrap income divided by total input minus normal loss units. Okay, now production remaining in process have to be valued as follows. So production remaining in process, nothing but closing stock, has to be valued as follows: material completed by 100%, labor completed by 50%, overhead completed by 50%. There has been no abnormal loss. Super. If there is no abnormal loss, entire loss is normal loss. If there is no abnormal loss, entire loss is normal loss. The company follow weighted average method. The company follow weighted average method for valuing the inventory. Prepare process account. So what we need to do in this question, there is no opening stock, but there is a closing stock. So what we need to first we need to prepare the statement of equivalent units, then cost per equivalent unit, then apportionment, then process account. These are the four steps which we need to follow for the process one account. Once we're done with the process one account, the same four steps has to be written for the process two account. Are you understanding? All of you? Okay. Now look into the question. We know that statement of equivalent units. Statement of equivalent units format is input, output, equivalent units. Input will take what all the units given. Output will take what all the units. Equivalent units will take percentage of work done in the current period. Percentage of work done in the current period. Completed means 100% completed. Completed means 100% completed. In this case, we are not going to take opening completed, introduced and completed. Opening completed, introduced and completed. No need to make the classification because we are following the weighted average method. Because we are following the weighted average method, no need to make the classification. No need to evaluate opening separately, introduce separately. Because we are following average, on average, club both, which is called completed units. Are you understanding? Now look at the solution. Look at the solution. Look at this. Process 1. Statement of equivalent units. Input totally 40,000. When it comes to output, introduced and completed 36,000. Normal loss 2,000. Closing stock 2,000. Introduced and completed 36,000. 100% complete, 100% complete. Just I am discussing the percentage first. 100%, 100%. Normal loss, we are not going to write the percentages. First of all, in the question, we don't know at what level of percentage completion they identified the loss. We don't know at what percentage of completion they identified the loss. At the time of identifying the loss, what is the percentage completion is not specified in the question. If it is not specified in the question, generally we'll assume it as 100%. In this case, it is normal loss. To the normal loss units, we are not going to apportion the cost. We are not going to apportion the cost to the normal loss units, so that we are not taking the unit. Just we are putting the dash. Abnormal loss 0. Abnormal loss is 0. Closing stock, they clearly stated in the question, material is 100%, labor is 50%, overheads is 50%. So 100%, labor and overheads 50%. Now we know the units. Let us calculate the equivalent units. 100%, 36,000 into 100%, 36,000, 36,000 into 100%, 36,000. 2,000 into 100%, 2,000, 2,000 into 50%, 1,000. If you make a total 38,000, labor is 37,000, overheads is 37,000. Are you understanding? All of you? Okay, next. Computation of cost per equivalent unit for each of the element. Now it's the time to calculate the cost per equivalent unit. Are you understanding? So how to calculate this? Material cost 6 lakh rupees, labor cost 1,20,000, factory overhead 2,40,000. Material equivalent units is 38,000, labor equivalent units is 37,000, overheads equivalent units is 37,000. We know the cost, we know the equivalent units, we can calculate cost per equivalent unit. So 6 lakh, 1,20,000, 2,40,000 equivalent units, cost per equivalent unit. It is a time to apportion. How to apportion? Simple. Introduce uncompleted will take material, labor, overheads. All the things are completed by 36,000, 36,000. So simply what we can do, introduced and completed equal to 36,000 units into cost per equivalent total. Have they given you the total? No. Let's make the total. 15.7895. 15.7895 plus 3.2432. 3.2432 plus 6.4865. 6.4865 equals to 25.5192. 25.5192 into 36,000 equals to 9,18,691. 9,18,691. This is the cost allocated to introduced and completed. Normal loss. We are not going to apportion the cost. And then closing stock. When it comes to closing stock, material equivalent units is 2,000. Labor equivalent units is 1,000. Overheads equivalent units is 1,000 into, we will take cost per equivalent unit of material 15.7895, labor 3.2432 overheads 6.4865. If you make a product of this, we'll get the total amount. That's the closing stock value. Look at here. Units introduced and completed 9,18,691.20. Closing stock 41,308.70. So as I taken the units, cost per equivalent unit, we'll get the total cost. Now prepare the process account. Material, see, we know that particulars units amount, particulars units amount. Here we'll write only material units 40,000. We'll take the total 9,60,000. Normal loss 0. There is no scrap income. If there is a scrap income, we would have accounted against normal loss. There is no scrap income in the question. So you are showing it as 0. Next, process 2 account 9,18,691, closing stock 41,309, total it come to 9,60,000. Now, whatever the process 2 that we written here, it will be shown under the, it will be considered for the process 2 preparation. How many units transferred to process 2? 36,000 units. Look at the question. Look at the question. Look at the question. Opening work in progress 0. Fine. Cost incurred during the month. Direct material they given 0 because here we are going to get process 1 account. From process 1 we are transferring the cost. From process 1 we transfer to process 2. Here we get the process 1 cost. Labor 1,60,000 factory over 2 lakh. Received in process 36,000. From where it is receiving? From process 1. Completed and transfer. Out of 36,000, 32,000 has been completed. Balance is 4,000. Out of 4,000, 1,500 is the normal loss. Abnormal loss is 0. Abnormal loss is 0. So what is the balance left out? 2,500. 2,500 is the balance left out. That is the closing work in progress. That is the closing work in progress and percentage completion given. So same way we need to calculate the statement of equivalent units, cost per equivalent unit, apportionment, and then we prepare the process. Okay, now look at here. Statement of equivalent units 36,000 input, 1,500 normal loss, 2,500 balance figure. Closing stock and complete is 32,000. Complete is 100%, 100%. Closing stock is 100%, 50%. We'll get 34,500, 33,250. Now equivalent cost per equivalent unit. We know the cost 9,18,691. Labor cost is 1,60,000. Overheads is 2 lakh. We taken the equivalent units cost per equivalent unit, and then we'll do the apportionment, and then we'll prepare the process, and then we'll prepare the process. Difference allowed due to rounding off has been adjusted. Normally it will be adjusted to closing stock. The difference, the rounding off difference of 10 rupees, 15 rupees, 20 rupees, whatever we get, that will be adjusted to closing stock. All of you clear till now? This is about the process costing. This is about the process costing. Okay, next. Let us start with the question based on the joint products and byproducts. Okay. Let us start with joint products and byproducts. We all know that this chapter is all about apportioning the joint cost to the products coming as an output from the process. It's a very simple chapter. It's just apportionment of the cost. According to me, it is just apportionment of cost under different methods. Physical units method, sale value method. When it comes to sale value method, sale value at split off point, NRV, net realizable value, sale value after further processing, like that. Different models are there. We all know that net realizable value method formula is sale value after further processing minus further processing cost. Sale value after further processing minus further processing cost. This question is also based on the NRV. Let us look into the question. First, let us study the question. Look at this. JB Limited manufacture three chemical products, that is XR, YS and ZT. There are three products, XR, YS and ZT. It processes input material in common plant facility to generate two intermediate products X and Y. So what they're mentioning? In joint common plant. Common plant means joint process. Joint process, they are generating two intermediate products X and Y. Okay, now in the proportion of 4:1, after a normal loss of 1/12 of the input of material. So we are going to have two intermediate products X and Y, and the normal loss expected is 1/12 of the input. Next, there is no market for these two intermediate products. Thus, X is processed further through separate finishing process R. So, directly for this X and Y, there is no market. So, they are further processing the X in the process R. After processing that, they are calling it as XR. Product is X, process is R. Now, they are called as XR. Product Y is converted into process YS by process S. Y in process S, so that they are called as YS. Next, the S finishing process also produces a waste material Z. So what is happening when it comes to process S along with the YS? It is giving some waste which is called as Z, which is not having market value. Thus, company convert Z after additional processing through process T into a saleable product ZT. So let us understand till here. From the joint process, we are getting two intermediate products X and Y. Both the products does not have the market value. Apart from these two products, there is a loss of 1/12 of the input. 1/12 of the input is the loss, which is normal. Now the point is X and Y does not have the market, so they are further processing. X they are further processing in R process, so that they are called as XR. Y they are further processing in S process, so that they are called as YS. But what is happening when they are further processing Y? When they are further processing Y, they are getting some waste, which is named as Z. Z is also not having the market, so that they are processing through T, so that they are calling it as ZT. Output they are calling it as ZT. So finally, how many products produced? I can say two joint products, that is X and Y, which has converted to XR and YS. And which is the byproduct means there is one byproduct, that is ZT. ZT is the byproduct, and loss of 1/12. 1/12 is the loss. Okay, now based on this, I have drawn the picture here. Look at this. This is the picture. You can clearly see here joint process. From joint process, we are getting X, Y loss. Then X is passing through R, converted into XR. Y is passing through S, converted into YS. But S is given some waste, Z, passing through T. It is converted into ZT. This is the picture belonging to the question. Okay, now look at the values. So we understood the process, joint product, byproduct. Let us look at the values. Totally, how many kgs given as input? 11,40,000 kgs given as input to the process. After, see, input material are processed each month in common plant facility, and after the separate finishing process, all losses are normal losses. See, after the separate finishing process, all losses are normal losses. Proportion of XR, YS and ZT emerge as follows. XR, how many units we are getting output? This is the output. This is the output. This is the input. Okay. Now, output is 7,60,000 kgs of XR, 1,90,000 kgs of YS, 19,000 kgs of ZT. Market price is 38.80, 72 rupees, 24 rupees. This is after further processing. These prices is after further processing. Before further processing, there is no market value. There is no market value before further processing. Why I am specifying this is they are asking to apportion using net realizable value method. When it comes to NRV, what is the formula? Sale value after further processing minus further processing cost. Now, how to calculate sale value? By multiplying this, we'll get the sale value after further processing. After further processing. Now, look into the further processing cost. Look at here. Separate finishing process R department. When it comes to R process, the further processing cost is, that means in R they are incurring 1,24,64,000. That is the further processing cost. When it comes to S, further processing cost is 41,04,000. When it comes to T, 3,04,000. This is the further processing cost. Common plant facility, this is the joint cost. These three elements are the further processing cost. This is the joint cost. And this is the sale value after further processing. All the information is given. Just what they are asking. You are required to calculate cost per unit and total operating profit or loss attributed to both product XR and YS. They are asking to calculate cost per unit. Cost per unit of XR, YS. How to calculate that? XR, YS. XR, YS, first we need to apportion joint cost. Then we need to take the further processing cost. Further processing cost is directly given. XR further processing cost is 1 crore 24 lakh 64,000. YS further processing cost is 41 lakh 4,000. Now we need to calculate the joint cost using which method? NRV, net realizable value method. How to calculate NRV? Sale value after further processing minus further processing cost. Okay, listen to me, listen to me. I'll present the values here so that you will get the clarity. Look at this. Total joint cost. How much? Rupees 1 crore 67 lakh 20,000. 1 crore 67 lakh 20,000. From this loss, we are not making any scrap income. Scrap income is not specified in the question. Scrap income is not specified in the question. So zero recovery from the total loss. I mean zero recovery from the last units. Okay, now how many units given as input? 11 lakh 40,000 kgs. 11 lakh 40,000 kgs. Out of 11 lakh 40,000 kgs, 1/12 is loss. So let me take that. 11 lakh 40,000 kgs 1/12 divided by 12 equals to 95,000 kgs is loss. Loss is 95,000 kgs. Okay, now and after this, in the proportion of 4 is to 1, in the proportion of 4 is to 1, we are getting the output of x and y. So 11 lakh 40,000 minus 95,000 kgs equals to 10 lakh 45,000. 4 is to 1. So into 4 divided by 5. 8 lakh 36,000 kgs of x. 8 lakh 36,000 kgs of x divided by 4. 2 lakh 9,000 kgs of y. 2 lakh 9,000 kgs of y. I hope you understand till here. So joint cost is given, input is given, we are calculating the output also. Now, in the R department, how much we are incurring? 1 crore 24 lakh 64,000. 1 crore 24 lakh 64,000. This is the further processing cost of x. Further, see, simple. Before x, before this, whatever we incur, it is called joint cost. After this, whatever we incur, we call it a further processing cost. We all know that. Okay. Until split off point, whatever the cost incurred, that is joint cost. After split off point, whatever the cost incurred, it is called the further processing cost. Okay, so this is the joint cost. Next, in the S department, they are incurring 41 lakh 4,000. 41 lakh 4,000. In the T department, they are incurring 3 lakh 4,000. So this is the further processing cost. Now let us calculate sale value after further processing. How to calculate this? See, we are getting the output of 7 lakh 60,000 into 38.80. And you may get the doubt, sir, we are giving the input of 8 lakh 36,000, but we are getting the output of 7 lakh 60,000. What about the gap? They clearly stated in the question. Look at the question. Look at the question. Look at the, okay, let me show the question to understand better. Here they mention, after separate finishing process, all losses are normal. All losses are normal, and there is no scrap income of that. So that we are neglecting. Okay. Now all losses are normal loss. Okay. So and they given the proportion. Now no need to think about the gap. No need to think about the difference. Okay. 7 lakh 60,000. Okay. Let me write the calculations first. Later on I will calculate. Here when it comes to YS, how many kgs we are getting as output? 1 lakh 90,000 kgs. 1 lakh 90,000 kgs into what is the price? 72 rupees. ZT 19,000 into 24. Let me calculate the values. 7 lakh 60,000 into 38.8 equals to 2 crore 94 lakh 88,000. 2 crore 94 lakh 88,000. Next, 1 lakh 90,000 into 72. That is 1 crore 36 lakh 80,000. 1 crore 36 lakh 80,000. 19,000 into 24 equals to 4 lakh 56,000. 4 lakh 56,000. This is the sale value after further processing. Okay. Now what we need to do? Sale value after further processing minus further processing cost, we get NRV. Now listen to me carefully. Listen to me carefully here. Sale value after further processing for the y. For the y is we need to add these two. We need to add these two and we need to exclude these two. Add sale values and exclude the further processing cost. We'll get the NRV. Are you understanding? Or else what we can do? Other way of doing. Other way of doing is simple. Other way of doing is first what we need to do? Take the net amount. What is the net amount? 4,56,000 minus 3,04,000. 4,56,000 minus 3,04,000 equals to 1,52,000 is the net amount. 1,52,000. This we can take it and reduce from the further processing cost. So minus 41,04,000. 41,04,000 equals to 39,52,000. So 39,52,000 minus 1 crore 36 lakh 80,000. 1 crore 36 lakh 80,000 equals to 97 lakh 28,000 is the NRV. 97 lakh 28,000 is the NRV. How I am doing? First I am taking the net income from the waste. Net income from the waste. This net income we are reducing from the further processing cost, and then sale value after further processing and net amount of the further processing cost will get 97 lakh 28,000. Same way 2 crore 94 lakh 88,000 minus 1 crore 24 lakh 64,000 will get the NRV. Using this NRV amounts, we are going to apportion the joint cost to X and Y. Once we apportion the joint cost, we'll add the further processing cost. We'll get total cost divided by number of kgs. 7,60,000 and 1,90,000 will get cost per kg. Okay, look into the solution. Look into the solution. That is the first requirement. Look at here. Statement showing operating profit or loss by each product after further process. That we'll look into that later. Working notes. Calculation of joint cost using net realizable value method. First, sale value 2 crore 94 lakh 88,000, 1 crore 36 lakh 80,000. Add byproduct net revenue 1,52,000. In our picture, I clearly shown how we get 1,52,000. If you add that and then less the post split off cost. Post split off cost is 1 crore 24 lakh 64,000 and then 41 lakh 4,000. Here they taken the net amount. Okay. If you take the net amount here 97 lakh 28,000. In my picture only I shown that 97 lakh 28,000 and net reliable value is 1 crore 70 lakh 24,000. Using this we are going to apportion the joint cost. Apportionment is 1 crore 6 lakh 40,000 and then 60 lakh 80,000. This is the joint cost. We all know the further processing cost. Further processing cost is 1 crore 24 lakh 64,000, 41 lakh 4,000. If you add these two, we'll get total cost divided by number of kgs. Divided by number of kgs, 7,60,000, 1,90,000. Look at here. Oh, here it is given. Here it is given. Okay. Joint cost, further processing cost. Okay. So I'll do one thing. Just I'll show the calculation so that you'll get the clarity. Look at here. Cost per unit. First we need to calculate cost per unit. Joint cost is 1 crore 6 lakh 40,000. 1 crore 6 lakh 40,000 plus 1 crore 24 lakh 64,000. 1 crore 24 lakh 64,000 divided by 7 lakh 60,000 kgs equals to 30.4. That is what they given here. 30.4. Same way we can calculate for the YS. Same way we can calculate for the YS. And then take the selling price. We'll get the net profit. Selling price given in the question 38.80, 72,000. We'll get the net price. Sorry, profit is 88.40, 19.20. I hope you understand this question. Very simple question, straightforward question. There is no much complication in this question. Fine. Now, look at the service costing. Service costing, we all know that one of the very simple chapter. It's all about making the total of cost, calculating the total cost and dividing by the cost object. We'll get the cost per cost object. But only point which we need to understand in this chapter is when it comes to cost object, it is a composite cost object. There are cases where we need to use the composite cost object. So what is this composite cost object? Means using two factors, two or more factors. Room days, number of rooms into number of days. Patient days, number of patients into patient number of days. Ton kilometers, number of tons into number of kilometers. Are you understanding, all of you? Okay, look at here. Mr. Intel newly sets up a homestay in Hanley, Ladakh, offering two types of rooms, single room and double room. So it is about, this is the question based on the hotel. This is the question based on the hotel. The expected occupancy percentage for the rooms is provided below. When it comes to single, 20 rooms are there, double, 10 rooms are there. Percentage of occupancy is 100%, 80%. The details of the expenses as forecasted are provided below. Staff salaries 30 lakh 20,000, food and beverage cost 20 lakh 16,000, lighting and power 8 lakh 60,000, repairs and renovation 4 lakh 94,000, laundry charges 3 lakh 22,000, building rent 14 lakh 40,000, miscellaneous expenses 6 lakh 12,000. First of all, there are two types of rooms: single room, double room. Single rooms, how many rooms are there? 100. Double rooms, how many? Sorry, 20. Single rooms 20, double rooms how many are there? 10. Percentage of occupancy of single room is 100%, occupancy of double room is 80%. And these all are the cost forecasted. These all are the expenses incurred, forecasting, estimated. Are you understanding? Now, room attendants are paid 125 per room day. 125 per room day. That means in addition to these cost elements, this is one of the extra cost. Room attendant wages or room attendants are paid 125 per room day. How to calculate room day? Number of rooms into number of days. Clear? Next. Mr. Intel, knowing about the power cut during nights at Hanley to preserve the natural light for astronomical research, set up emergency power backup being charged from the customer separately 200 rupees per room if requested. So this is one of the additional point which we are looking into. Due to power failure, they are arranging the power backup. If the customer wants the power backup, they are going to charge 200 rupees extra per room. 200 rupees extra per room if requested. Okay, now next. The rent of the double room is to be fixed at 1.5 times the single room. Suppose if single room is X, single room rent is X, then double room rent is 1.5x. That's it. Okay, next. In the month of June, they are speaking about the month of June. Mr. Matrix, along with his family, visited Hanley Dark Sky Reserve to experience the breathtaking view of the stars. For one night stay at the place, he approached Mr. Intel to book a double room and also requested the emergency power backup at night. So, the customer name is Matrix. He is requesting for the double room for one night. He is requesting for the double room for one night with the emergency backup. If it is with emergency backup, 200 rupees extra. If it is with emergency backup, 200 rupees extra. Now we need to fix the double room rent. Now you are requested to calculate rent to be charged from Mr. Matrix, considering profit 25% on total takings. 25% on total takings. They are asking to calculate the how much to be charged to Matrix. If you want to calculate how much to charge to Matrix, first we need to know the single room rent, because double room rent is 1.5 times of the single room. So if you know the single room rent, automatically you can calculate the double room rent. And along with the power backup, so 200 rupees extra. One more point is here the profit expectation of the management is 25% of the total takings. What do you mean by total taking? Sales. 25% on sales, that is 25 divided by 100 on sales. If you want on cost, we all know that 25 divided by 75 on cost. From the sales reduce the profit. From the sales reduce the on sales means below is sales. Denominator is on sales means denominator is sales. Sales minus profit 25. 75 is the cost. On cost. This is on cost. This is on cost. All of it clear? Now what we need to do? Very simple. Whatever the cost given, make a total, we'll get the total cost. But the only point is, please understand, here they are asking specifically for the June month. They are given information for the June month. They are given information for the June month. We can take it on monthly basis. In the month of June, they are asking. So 30 days. We can take it as that number of days as 30 days. Number of rooms, see, room days we need to calculate. So number of rooms into number of days. In this question, the cost object is room days. Number of rooms into number of days. They give the rooms, but days is 30 days because we are in the month of June. But here, all this information is per annum. Sir, where they stated, look at here, the details of expenses forecasted are provided below. Forecasted means generally it is yearly basis. Forecasting will happen on yearly basis generally, because in this question they didn't specify to what period the information is about. They didn't specify. Generally the forecasting will happen on yearly basis. Budget will be yearly basis. We all know that Indian government also is coming up with a budget yearly basis. Forecasting, estimations, everything will happen on year. Generally, I'm telling you general sense. On general sense we have to take it as per annum. Are you understanding? Monthly forecasting will not be there. Normally it will be yearly forecasting. Clear? Now the point is listen. This is yearly. We need to convert into per month. We need to convert into per month. We need to calculate room days. How to calculate room days? Number of rooms into number of days. First one, single room. 20 into 100%, 20 rooms into number of days is 30. Okay, 600. Next, double room, 10 into 80%, 8 rooms into how many days? 30 days. 240. Total it comes to 840 room days. Total it comes to 840 room days. Look at the solution. Okay, everything they take per annum. Okay, room days also they convert into per annum. That's fine. Okay, fine. See, either you can take per month basis or per annum basis, your answer is not going to change. Even if you take per month basis, your answer is not going to change. Are you understanding? Okay, here they are doing it on annual basis. Look at this. Look at this. As of now, don't look at this. As of now, don't look at this. Listen to me carefully. Single room, 20 rooms, 100% occupancy. We'll get 20 into 100%, 20 rooms into number of days is 360 days, 7,200. Double rooms, 10 rooms, occupancy is 80%. 10 rooms into 80%, 8 rooms into 360 days. They're taking per annum. So 10,080 is the room days. 10,080 is the room days. Don't look into the equivalent rooms. I'll explain that later. Now we need to make the total of all the costs. So staff salaries 30 lakh 20,000 straight away given in the question. Room attendant is going to get 125 rupees per room day. How many room days? 10,080. 10,080 into 125. But 12 lakh 60,000. This entire information is there in the question. Ditto copy paste. Total comes to 1 crore 24,000. Total comes to 1 crore 24,000. Now, this is the total cost, but we require the total takings. How to calculate total taking? Total takings equal to total cost plus profit. Total cost is 1 crore 24,000 plus profit is 25 by 75. That is 1 by 3 on cost. 1 by 3 on cost. Look at here, 25% of the total takings. 25% of total takings. How to apply that? Okay. Actually, I'll tell you simple. Both one and the same, but the only difference is here. Instead of doing like this, I'll do it in different form. Total takings. Total takings equal to 1 lakh 24,000. Sorry, 1 crore 24,000 plus 25% of total takings. That is 25 divided by 100 on total takings. 25 by 75 on cost. So what I'll do? 1 crore 24,000 into 25 divided by 75 equals to 33 lakh. Sorry. 33 lakh 41,333 plus 1 crore 24,000 equals to, this is the total value. Okay. So total takings equal to 1 crore 33 lakh 65,333. 333. This is the total takings. Okay, total takings. Now how to calculate total takings? Other way, let rent be R. They taken R. Let us take R. Lent. Okay. Let rent of single room. Rent of single room be R. Then double room is 1.5 R. See, room days 7,200. 7,200 into R. 7,200 R plus 2,880 into 1.5 R. 2,880 into 1.5 R equals to 4,320 R. 4,320 R equals to 1 crore 33 lakh 65,333. Total comes to 11,520 R equals to 1 crore 33 lakh 65,333. Now R equal to 1 crore 33 lakh 65,333 divided by 11,520 equals to approximately you will get 1,160. 1,160 for double room 1,160 into 1.5 equals to 1,740 plus okay 1,740 plus 200 for the power backup. Totally we are going to charge 1,940. Totally we will charge 1,940. Look at here. Totally we charge 1,940. See what they done and what I done is similar, but I like to solve like this to make it as x 1.5x or 1.2.5 whatever they given. You can follow the whatever the method that they given. Both will give the same answer. Okay, so this is about service costing. Let us start with the question from the standard costing, which is based on the material variances, which I already uploaded the video. For the material variances. Okay, now look at this question. Look at this. Okay, material variances. We all know that as I given you the format, we are going to take the four columns, that is SQ into SP, AQ into AP, AQ into SP, RAQ into SP. SQ stands for standard quantity, nothing but quantity allowed, quantity permitted for the actual production. Quantity permitted for the actual production. Generally, just let me let me give the example. 2 kgs permitted, 1,000 units produced. So how many kgs will be permitted means 2 kgs into 1,000 units is the production. So 2 kgs into 1,000, 2,000 kgs will be permitted, allowed. Actual consumption is 1,800 means favorable. We are permitting 2,000 kgs, but they consumed only 1,800, which is favorable to the organization. We are permitting 2,000 kgs, but they are consuming 2,200, which is adverse to the organization. That is called standard quantity. And standard price fixed by the management 10 rupees, but they purchased at 8 rupees, 2 rupees saved, favorable. 10 rupees permitted, purchased at 12 rupees, 2 rupees extra cost, which is adverse. That is called standard quantity and standard price. Standard quantity is quantity permitted, standard price is price permitted or price fixed. And we know that actual quantity, actual price, that is the quantity, actual quantity and actual price paid. And then third column is AQ into SP, actual quantity at standard price. RAQ, revised actual quantity. What does it mean? Simple. Actual quantity in standard mix. Actual quantity in standard mix, which helps to calculate the mix variance into standard price. Clear till now? Next. And then we'll calculate the variances. How to calculate variances? Material cost variance. According to our columns, that is SQ into SP, AQ into AP, AQ into SP, RAQ into SP. So material cost variance 1 minus 2, material rate variance 3 minus 2, material usage variance 1 minus 3, material mix variance 4 minus 3, material yield variance 1 minus 4. The same chart is applicable for labor, the same chart applicable for variable overheads, the same chart applicable for fixed overheads, and the same chart applicable for the sales variance. For all the variances, we can use the same chart but name change. Here material cost, there it is labor cost, like that. Okay, now these are the formulas. So let me look into the question. Let us look into the question. I'm telling you again, I'm going to solve it in little bit different format. To understand better this question, you just look into the standard costing videos. Okay, now compute the missing data indicated by the question marks from the following particulars A, B. Now what they given? Standard price per unit 12 rupees, 15 rupees. Actual price per unit 15 rupees, 20 rupees. Standard input 50. Here it is not given. Actual input 0, 70. Material price variance, material usage and material mix. See, actual what they given. Look at this. Standard price, actual price, standard quantity, actual quantity. They are asking price and usage and cost variance for all two types of material. Material A, material B. Material mix variance for both products together was 45 adverse. This is the information given. They are asking to calculate all the missing data. Okay, let me explain how to do this. See here. Okay, look at this. See, first what we can do, we can start with, see, general this kind of question always start with the values what they given. 300 rupees adverse for material usage variance. Listen to me carefully. I already told you my format is first column is SQ into SP, second column is AQ into AP, third column is AQ into SP, fourth column is RAQ into SP. This is the four columns. This is the four columns. This is the, let it be there. Now, material usage variance formula is 1 minus 3. According to my format, material usage variance is 1 minus 3. First column SQ into SP minus third column AQ into SP. This is the format. Okay. Now, I'll write here so that we'll get more space. Okay. Now, material usage variance SQ into SP minus AQ into AP. Okay, sorry, 3 na AQ into SP. SQ into SP minus AQ into SP. Material cost variance SQ into SP, first column, third column AQ into SP. In these two, which is common? SP is common. Let me take the SP common. So standard quantity minus actual quantity into standard price. Material cost variance 300 adverse negative 300. So negative 300 equal to standard quantity is not given in the question. Actual quantity given. So standard quantity minus actual quantity 70. This is only about B. This is only about material B. So actual quantity is 70 into standard price 15 rupees. So minus 300 equal to 15 standard quantity minus 70, 15 are 1050. Okay. Now 15 standard quantity equal to 750. Standard quantity equal to 750 divided by 15. That is 50. So standard quantity is 50. Have you understand this? We done with the one calculation. Now we know the standard quantity, we know the actual quantity, we know standard price, actually everything is known. Now we can calculate material price variance and cost variance. Let me calculate that. Material cost variance equal to SQ into SP. Okay, let me calculate price variance first. Look at here. Material price variance. Material price variance equal to formula 3 minus 2. Third column is AQ into SP. Third column is AQ into SP minus second column is AQ into AP, which equals to, if you take actual quantity common, that is standard price minus actual price. What is the actual quantity? Sorry, 70. Actual quantity is 70. Actual quantity is 70. Standard price. Standard price is 15 minus actual price is 20. Negative 5. We'll get 15 minus 20 minus 5. Minus 5 into 70. That is minus 350. Nothing but 350 adverse. 350 adverse. Let me write that. Okay. Cost variance is sum of these two. Cost variance is sum of these two. 350 adverse, 300 adverse, 650 adverse. Even if you want to calculate, we can calculate that. How to calculate that? Look at this. Even if you want that, you can calculate that. How to calculate that? Material cost variance equal to SQ into SP minus AQ into AP, which equals to standard quantity. Standard quantity is 50 into standard price 15 minus actual quantity 70, actual quantity 70 into actual price 20. So 50 into 15, 750 minus 70 into 20, 1400. Gap is 650 negative adverse. We are getting the same answer. We done with the B, material B. Now when it comes to material A, nothing has been given. Okay, what we can do, the only thing, see, we are stuck in here. What are the other variants available? 45 rupees adverse mixed variance. Okay, the formula for the mixed variance, look at here. The formula for the material mix variance is 4 minus 3. 4 minus 3. 4 is RAQ into SP minus 3 is AQ into SP. The gap is, so common thing is standard price. So RAQ minus AQ equals to RAQ minus AQ into standard price. RAQ minus AQ into standard price. Material mix variance. Adverse 45, negative 45. So negative 45 equals to, here 45 rupees is both A and B. We have to take both A and B. Actual quantity is unknown. Okay. Now what we can do, I'll tell you one thing. We have to write A separately, B separately. Now, actual quantity of A is unknown. We can take it as X. We can take it as X. Actual quantity of B is 70. Revise the actual quantity. What we need to do? Revise the actual quantity is nothing but actual quantity in standard mix. Actual quantity standard mix. Actual quantity equal to 70 plus X. Actual quantity 70 plus X. We need to divide in standard mix. What is the standard mix proportion? What is the standard mix? Look at here. Look at this. Let me write that. Look at this. Standard mix is 50-50. Nothing but 1 is to 1. If it is 1 is to 1, half is A. Material A. Half of this is how much? 35 plus 0.5x. Half is B. 35 plus 0.5x. Okay. Now, using that, I am going to do this. See here. Let me write the full form. Minus 45 equals to, revised actual quantity is 35 plus 0.5x minus actual quantity of A. Actual quantity, okay, let me write AB separately so that you people will get the clarity. I'm writing it for A. When it comes to A, 35 plus 0.5x is the revised actual quantity minus actual quantity is X. Actual quantity is X into standard price is 12 rupees. This is about A. B equals to, B is 35 plus 0.5x minus 70. Actual quantity is 70. Let me take 70 into standard price is 15. Let us solve this. Finally, it become how much? Finally, it will become, look at this. 35 plus 0.5x minus x. It will become 35 minus 0.5x into 12 plus 35 minus 70. So minus 35. So 0.5x minus 35 into 15 equals to negative 42. Negative 45. Negative 45. Negative 45. Let us rearrange this. 35 into 12. 35 into 12 for 420. 420. Okay. So 420 minus 6x plus 15 into 0.5. 7.5x minus 35 into 15 equals to 525. Minus 525 equals to minus 45. So the net amount is 1.5x. Here the net amount is minus 105 equals to minus 45. So 1.5x equals to 150. So x equals to 100. X equals to 100. So actual quantity is 100. Now we know actual quantity, standard quantity, actual price, standard price. We can calculate all the three variances. Okay, look at the question. Look at the solution. X is 40. Where we done the mistake? I think some calculation error. Let me sort out that. Thirty-five plus 0.5x minus x into standard price 12. Oh, we have taken, oh my god, this is the mistake. Okay, standard price of A is 12, standard price of B is 15. 70, okay. Okay, the mistake, what is happened is, here I did the mistake. Okay, now 1.5x minus 105 equal to minus 45. So 1.5x equals to 60. It is not 150, I'm sorry, 60. So x equals to 40. Yeah. So what they got, we are also getting the same answer. So x is not 50, x is 40. Using this, we can calculate the remaining variances. Look at the solution. Look at here. 50, 40, material price variance for A. We calculate for B 350, usage variance I think 300, 650 adverse, 650 adverse. Okay, so this is about standard costing question. You can calculate the price variance, usage variance, cost variance using the formulas. We all know that 1 minus 2, 3 minus 2, 1 minus 3. Okay, this is about standard costing. Look at the marginal costing. This time they given some unique question. This time they had given the unique question, marginal costing. Look at the question. But it's not that complicated too. It is simple only. Look at this. Okay. Marginal costing. Look at this question. See, few things I'm not solving because wherever I feel it is so simple, I'm skipping that. Okay. So that you can manage by yourself. Now look at the marginal costing. Garment food products is a new entrant in the market for chocolates. It has introduced a new product, Sweetie. This is a small rectangular chocolate bar. The bars are wrapped in aluminum foil and packed in attractive cartons containing 50 bars. A carton, a carton is therefore considered the basic sale unit. This is the only point which is useful in this question. Carton is the basic sale unit. Although management had made detailed estimate of cost and volume prior to undertaking this venture, new projections based on actual cost experience are now required. So what I mean to say, this paragraph full of story. The only thing what we need to understand from this paragraph is curtains is the units. Curtain is the units. Next, they're manufacturing some chocolate and putting into the curtain box. That box is the unit. Next, income statement for the last 2 quarters are each thought to be representative of the cost and productive efficiency we can expect it in the next few quarters. There were virtually no inventories on hand, so closing stock is zero. Closing stock is zero. At the end of each quarter, income statement reveal the following. Income statement reveal the following. They given 2 quarters information, first quarter and second quarter, and they're expecting the same thing is going to continue in the future. Okay, now look at here. Sales. Sales of the first quarter is 12 lakhs, that is 50,000 units into 24. Let me specify that. First quarter they are selling 50,000. First quarter they are selling 50,000. First quarter they are selling 50,000. Second quarter they are selling 70,000 at the rate of 24. They given the values. Cost of goods sold 7 lakh, 8 lakh, 80,000. Gross margin, selling and administration 6 lakh 50,000, 6 lakh 90,000. Net income given less tax. Net income is 90,000, 66,000. Now, the firm overall marginal and average income tax rate is 60%. So tax at the rate of 40%. Tax at the rate of 40%. This 40% figure has been used to estimate the tax liability arising from the chocolate operation. That's fine. Required. Management would like to know break-even point in terms of quarterly curtain sales for the chocolates. So cut and sales, they want to know the units. Cut means they want to know the units. What is the formula? Fixed cost divided by contribution per unit. Fixed cost divided by contribution per unit. So please understand, whenever it comes to marginal costing, the preferred classification is variable cost and fixed cost. But in this question, they given cost of goods sold, selling and administration. This classification supports for the stock valuation, not for the decision making. When it comes to decision making, always we need to classify the cost into variable cost and fixed cost. So what we need to do, they given the information at two volumes. They given the information at two volumes, 50,000, 70,000. We all know that when the information is at two volumes, how to identify the nature of the cost. We all know that how to identify the nature of the cost. If at two different volumes, total same, then we'll call it as fixed cost. Per unit same, then we'll call it as variable cost. If both are not same, then we'll call it as semi-variable cost. And we know that how to classify the semi-variable cost into variable cost and fixed cost. Variable cost per unit equal to change in cost divided by change in units. We'll get the variable cost per unit. Are you understanding? All of you? Okay, listen to me carefully. First, cost of goods sold. Listen to me. First, cost of goods sold 7 lakh, 8 lakh 80,000. So it is not a fixed cost. 7 lakh divided by 50,000. 7 lakh divided by 50,000 equals to 14. Next, 8 lakh 80,000 divided by 70,000. 12.5. 14, 12.5. So variable cost is not same. So it is a semi-variable cost. We need to classify into variable cost and fixed cost. Same way, selling and administration overheads also semi-variable cost. We need to classify variable cost and fixed cost. That is the first discussion. Look into this. Let me discuss about cost of goods sold. Variable cost per unit equal to change in cost divided by change in units. Change in cost is 7 lakhs become 8 lakh 80,000. So 1 lakh 80,000 is the change in cost divided by change in units is 20,000, which equals to 9 rupees. Which equals to 9 rupees is the cost of goods sold. Next, selling and administration, change in cost divided by change in units equals to change in cost. 6 lakh 50 becomes 6 lakh 90. So 40,000 divided by 20,000, which equals to 2 rupees. So total variable cost is 9 plus 2 equals to 11 rupees. 9 plus 2 equals to 11 rupees. Selling price is common 24 rupees. So contribution per unit equal to 24 minus 11, which equals to 30. Are you understanding? All of you? Okay, so this is how we'll calculate contribution per unit. Now they are asking break-even point. Break-even point equal to fixed cost divided by contribution per unit. So listen. Let me calculate the fixed cost. How to calculate fixed cost? When it comes to cost of goods sold, first quarter 7 lakh. How many units? 50,000. So total variable cost equal to 50,000 into 9, 4 lakh 50,000. 50,000 into 9, 4 lakh 50,000. Fixed cost equal to total is 7 lakh rupees minus 4 lakh 50,000, which equals to 2 lakh 50,000 from the cost of goods sold. Same way, we need to calculate selling and administration overheads. Total variable cost equal to 2 into 50,000, which equals to 1 lakh. So fixed cost equal to total is 6 lakh 50,000. So 6 lakh 50,000 minus 1 lakh rupees. So which equals to 5 lakh 50,000. Total fixed cost is 5 lakh 50,000 plus 2 lakh 50,000. It comes to 8 lakhs. Yeah, 2 lakh 50, 5 lakh 50, 8 lakhs. Have you understand this? Okay, so break even point equal to fixed cost is 8 lakh rupees, contribution per unit is 14 rupees. Sorry, 13. Contribution per unit is 13. So 8 lakhs divided by 13 equals to 61,538. 61,538. Let's look into the solution. See, first I taken 9 rupees and fixed cost is 2 lakh 50,000. 2 rupees and fixed cost is 5 lakh 50,000. So total 8 lakh divided by 13, 61,539. This is the answer for the first requirement of the marginal costing. What is the second requirement of the question? The second requirement is, look at this. Look at the second requirement. Management estimate that there is a investment of 30 lakh rupees in this product line. What quarterly cotton sales and total revenue are required in each quarter to earn an after tax return of 20% per annum on investment? So, what they're asking, quarterly sales, they're asking quarterly sales, quarterly sales, cotton sales means units to be sold, units to be sold. If the total revenue are required to in each quarter to earn after tax return of 20% per annum on investment. First of all, 20% on investment is 30 lakhs into 20%, which equals to 6 lakhs. This should be PAT. This should be PAT. We want profit before tax. Are you understanding? All of you? Huh. We want profit before tax. How to calculate profit before tax? We all know that profit before tax equal to PAT divided by 1 minus tax. PAT is 6 lakh rupees. PAT is 6 lakh rupees divided by tax rate is 40%. So 1 minus 40% is 60% equals to 10 lakh. 10 lakhs per annum. PBT. PBT is 10 lakhs per annum. I can call it as PBT or operating profit. Or operating profit. See, please understand why I am converting before tax. Please understand. First, sales minus variable cost will get contribution, minus fixed cost will get the EBIT or operating profit. EBIT or operating profit. Okay, they're expecting 20% after tax. I'm converting to before tax, and then interest is zero. So it will be called as the EBIT or operating profit. So operating profit per annum is 10 lakh. Operating profit per annum is 10 lakhs. But here what they're asking quarterly. They're asking quarterly. So per quarter, how much is expected? 2,50,000. Per quarter expectation is 2,50,000. Are you understanding? So what we need to do? Sales equal to, we all know that fixed cost plus profit divided by contribution per unit. How to calculate sales at desired profit? Sales at desired profit equal to fixed cost plus profit divided by contribution per unit. What is the fixed cost per quarter? Totally 8 lakhs. Totally 8 lakhs is the fixed cost. Are you understanding? Totally 8 lakhs is the fixed cost. No, just reconfirm that. No, 8 lakhs is per quarter. 8 lakhs is per quarter. Yeah. 8 lakhs is per quarter. 8 lakhs is per quarter. So we can take it directly. 8 lakhs plus 2,50,000 divided by contribution per unit is 13. 8 lakhs plus 2,50,000 equals to 10,50,000 divided by 13 equals to 80,769. Look at the solution. 80,769 quarterly sales. Have you understand this? All of you? Okay. Now, and one more thing I'm solving. If you have any doubt at any point, please mention in the comment section. Definitely, I'll revert back to that. Definitely, I'll sort out that. If you have any doubt, please mention in the comment section. Okay. Now, look into the requirement 3. Look into the requirement 3. What is the requirement 3? Look at here. The firm marketing people predict that if the selling price is reduced by 1.5 per carton, rupees 0.03 off per chocolate bar, and rupees 1,50,000 advertising campaign among school children is mounted, means they're asking to spend that. Sales will increase by 20% over the second quarter sales. Should the plan be implemented? So it's very simple. What they're asking, we know that present profit and everything. Now they're making certain changes. What are the changes? Selling price will decrease by 1.5. What is the present selling price? 24. In such case, it will become 22.50. And cost will be 1,50,000. Advertising campaign among school children is mounted. That means 1,50,000 extra cost. This is also one of the fixed cost. This is also one of the fixed cost. So 1,50,000 extra. 8 lakhs is existing. So it will become 9,50,000. 9,50,000 fixed cost. So sales will increase by 20%. Present sales is 70,000 plus 20%. It will become 84,000. It will become 84,000. So at this sales, we need to calculate profit. We need to calculate profit. Okay, simple. How to do this? Sale units equal to fixed cost plus profit divided by contribution per unit. Sale units is 84,000 equal to fixed cost is 9,50,000 plus profit divided by contribution per unit is 13. Oh, contribution per unit is going to change. Contribution per unit is going to change. What is the contribution per unit? Contribution per unit equal to selling price minus variable cost per unit. Selling price is 22.5 minus variable cost per unit is 11 rupees. So it will become 10.5. There is no change in the variable cost. There is no change in the variable cost. So that I straight away taken 11 rupees. So it will become 11.5. So it will become 11.5. 11.5. So 84,000 into 11.5 equals to 9,66,000 minus 9,50,000. Sorry, 9,66,000 minus 9,50,000 equals to 16,000 is the profit. 16,000 is the profit. Earlier, how much profit we are getting? Look into that. See, 11.50, 9,50,000, 84,000 patterns. So 16,000. After tax, 9,600. Earnings reduced from 66,000. This 66,000. Okay, let we calculate that. Okay, how to get 66,000? Sales units equal to fixed cost plus profit divided by contribution per unit. In the present scenario, sale units is 70,000. Sale units is 70,000. Fixed cost is 8 lakhs plus profit divided by contribution per unit is 13. Let us solve this. 70,000 into 13 equals to 9,10,000 minus 8 lakhs minus 8 lakhs equals to 1,10,000 minus 40% tax minus 66,000. This is the existing profit. New profit is 16,000, which is better. Existing profit is better. So we are not going to adopt the change in strategy. We are not going to adopt the. We are not going to adopt. We are not going to adopt the sales change in sales strategy. Okay. So this is about marginal costing question. This is about marginal costing question. Last question is based on the budgetary control. First, let us look into the question. Let us look into the question. Budgetary control. Look at this. Look at the question. The budgets for activity and cost of PQR Limited for the first 3 quarters of operation are shown below. They are given 3 quarters, quarter 1, quarter 2, quarter 3. Months is 1 to 3, 4 to 6, 7 to 9. And everything is in thousands. Everything is in thousands. They given activity sale units 9,000, 17,000, 15,000, production units 10,000, 20,000, 15,000. Cost, direct material. There are two types of material, material A, material B. They given cost in rupees 60,000, 1,20,000, 90,000, 50,000, 1,75,000. Production labor 1,80,000, 2,85,000, 2,30,000. Manufacturing overheads excluding depreciation 90,000, 1,20,000, 1,05,000. Depreciation of production machinery 20,000, 20,000, 20,000. Administration expenses 25,000, 25,000, 25,000. Selling and distribution expenses 38,000, 54,000, 50,000. This is the information given. The figures shown above represent cost structure of PQR Limited, which have the following major features. Fixed element of any cost is completely independent of activity level. So simple. What they mean to say? Fixed cost is constant. Fixed cost is constant irrespective of the activity or is irrespective of the level of production. Fixed cost will be constant. Next, any variable element of each cost display a linear relationship with activity level. What does it mean? Variable cost increases with increase in production. Linear relationship. Variable cost increases with increase in production. We all know that. Okay, next. Except that variable labor cost become 50% higher for activity in excess of 19,000 units per quarter due to the necessity of overtime working. So, except the variable labor cost. When it comes to labor cost, if it is in excess of 19,000 units, the 15% higher for the at 50% higher compared to existing. Existing 10 rupees means it will become 15 rupees beyond 19,000 units. Remember that there is a linear relationship for the variable cost, but the only exception is labor cost. When it comes to labor cost, if the units is more than 19,000, then it will increase by 50%. Labor cost will increase by 50%. Are you understanding? 10 rupees means it will be added by 50%, 15 rupees because of overtime working. Overtime working means overtime premium. When they are working for overtime, they will expect overtime premium. Because of payment of overtime premium, it has been increased by 50%. So it becomes 15 rupees. Are you understanding? Next, the variable element of selling and distribution expenses is function of sales. So here the variable cost depends upon production, whereas here the variable cost depends upon sales. Selling and distribution. Selling and distribution depends on sales. Manufacturing depends on production. Next, all other costs with variable element are function of production volume. All other than selling and distribution, everything based on the production. Next, activity for each quarter is spread evenly throughout the quarter. In quarter 4, production level will be set equal to sales level. Fine, production is equal to sales. So closing stock is 0. Production and sales in this quarter is expected to range between 15,000 units and 21,000 units. The most likely volume is 18,000 units. Please understand, the range is 15,000 to 21,000, but most likely is 18,000. 3 predictions are there. Pessimistic, optimistic, most likely. Okay, pessimistic 15k, optimistic 21k, most likely 18k. Okay, next. In month 9, it will be possible to accurately estimate the sales of quarter 4. So as of now, we cannot estimate accurately, but in the month of in the 9th month, we can estimate accurately. Okay, as of now, what we can do is like, according to us, in the 4th quarter, what is possible means either it will be 15,000 or it will be 18,000 or it will be 21,000, but most likely is 18,000. Okay, next. Cost structure will remain the same as in quarter 1 to 3, except the following. Labor cost will rise by 12.5%. Variable labor input per unit of output will decrease due to learning curve effect, such that 80% of the previous labor input per unit of output will be required in quarter 4. Threshold for overtime working remains 19,000 units. So please understand what all the changes happen for the quarter 4. What all the changes happen for the quarter 4 is, number 1, labor cost will rise by 12.5%. At present, how much is the labor cost? At present, how much is the labor cost? Okay, 10,000. 1,80,000 divided by 10,000, 18 rupees. 1,80,000 divided by 10,000, 18 rupees. Labor cost is 18 rupees per unit. Labor cost is 18 rupees per unit. It is going to increase by 12.5%. It is going to increase by 12.5%. Next, variable labor input per unit of output will decrease due to learning curve effect. Sir, what is this learning curve effect? So when the person is doing routinely the same work, because of efficiency, the time taking will be reduced. If you keep on writing the exams, instead of completing in 3 hours, you may complete in 2.5 hours. same question paper for 10 times. Just example, same question paper for the 10 times you are writing. First time you may take more than 3 hours, but second time 3 hours, third time it will be slightly reduces. By the 10th time you will be completing within 2 hours because of learning curve. That is what they are mentioning here. Here they are mentioning 80% is the labor time that can be possible. So one side labor cost is increasing, other side labor hours is decreasing. One factor is increasing, other factor is decreasing. Keep it in mind. Next. And they given the threshold overtime limit. Overtime limit is more than 19,000 units. Overtime limit is more than 19,000 units as previous. Okay, now fixed factory overheads and fixed element of selling and distribution cost will each rise by 20%. The variable element of selling and distribution cost will be unaltered. So when it comes to factory overheads and fixed element of selling and distribution cost will increase by 20%. Variable cost will remain same. Prepare statement to show under each cost classification given in the budget variable cost per unit and fixed cost which will be effective in quarter 4. They are asking for the quarter 4, they are asking to present the variable cost per unit and fixed cost for the each cost classification. Prepare flexible budget for the production cost of quarter 4. Okay, now listen to me carefully. Listen to me carefully. What are the cost elements given? Material. Is there any change in the materials account to given information? No change. Look at here. Here it is 10,000, 20,000, 15,000. Let me take that. 10,000 in the first quarter, 20,000 in the second quarter, 15,000 in the third quarter. They're asking variable cost and fixed cost. First, we need to identify nature. Nature. Look at here. Material A. What is the nature of material A cost? It is variable. So, how can you mention that? Because variable cost. Okay, I can tell you. Cost per unit. Cost per unit is same. Cost per unit is same. 60,000 divided by 10,000, 6 rupees. 1,20,000 divided by 20,000, 6 rupees. 90,000 divided by 15,000, 6 rupees. 6 rupees, 6 rupees, 6 rupees. So, it's a variable cost. It will be constant for the fourth quarter also because only changes fixed cost. Only changes fixed cost increase of 20%. Variable items will be constant. In variable items also, one factor is changing, that is labor cost. Labor cost increasing by 12.5% and decreasing by, due to learning curve, the efficiency is 80%. Due to learning curve, the time taking percentage is only 80%. Okay, so it is a variable cost. It will remain same, 6 rupees. Next. Material B, 50,000 divided by 10,000, 5. 1 lakh divided by 20,000, 5. 75,000 divided by 15,000, 5. So it is also variable cost, it will also remain same, 5. Production labor, 1 lakh 80,000, 2 lakh 85,000, 2 lakh 30,000. Look at here. 1 lakh 80,000 divided by 10,000, 18 rupees. 2 lakh 85,000 divided by 20, it is 14.25. Per unit is not same. Total is also not same. So it is a semi-variable cost. It is a semi-variable cost. Such semi-variable cost, we need to classify into variable cost and fixed cost. How to do that? Let me take first two. These two. Change in cost, 1 lakh 5,000. Change in cost, 1 lakh 5,000 divided by change in units, 10,000. Change in cost divided by change in units, 10,000. So we'll be getting 10.50. We'll be getting 10.50 variable cost. Fixed cost equal to total variable cost. Total cost 1,80,000 minus 10,000 into 10.5, which is 1,05,000, equals to 75,000 is the fixed cost. Fixed cost is 75,000. Variable cost per unit is 10.50. And they mentioned that fixed cost will increase by 20%. Look at here. Fixed factory overheads. Okay, only factory overheads. And fixed element of selling and distribution will increase by 20%. Okay. That's fine. Next. Manufacturing overheads. It is also semi-variable cost. Depreciation, fixed cost. Administration expenses, fixed cost. Selling and distribution expenses, semi-variable cost. This we need to classify into variable cost and fixed cost. This we need to classify into variable cost and fixed cost. They clearly stated these two fixed costs will increase by 20%. Okay. Now variable cost 10.50, it will increase by 12.5%. Look into the solution. Okay. Now look at here. I have written the solution for all these things. First, sales production. First quarter 9,000, 10,000, second quarter 17,000, 20,000, third quarter 15,000, 15,000. Okay. Now, fourth quarter is also the production and sales will be same. Now, the point is direct material consumed both are variable cost, 6 rupees, 5 rupees. So A and B both are variable cost. Direct labor, please understand, I forgot to mention one point. What is that point means? They given three quarters: first quarter, second quarter, third quarter. In the first quarter, production is 10,000, second quarter production is 20,000, third quarter production is 15,000. Okay. Okay, let me show it here only. 10,000, 15,000, 20,000. The point is, when it comes to 20,000, there will be overtime premium. There will be overtime premium. Don't consider this. First, you calculate these two. First, you calculate these two because 10,000, 15,000 is below 19,000. 10,000, 15,000 is below 19,000. When it is below 19,000, when it is below 19,000, no need to consider the overtime premium. There will be no change in the labor cost. Okay, so what I mean to say, we'll take these two. We'll take these two and we'll calculate variable cost. Variable cost is 10 rupees per unit. Fixed cost is 80,000. Are you understanding? Now what will happen? Variable cost is 10 rupees. Beyond 19,000, how much is the variable cost? Means 15 rupees because 50% has to be added. 50% has to be added. 15 rupees. This is applicable only for quarter 2. This is applicable only for quarter 2. And when it comes to quarter four, three things possible: pessimistic 50k, optimistic 21k, and most likely 18k. For these two also, we are going to evaluate at 10 rupees, but only for 21k, we are going to evaluate at 15 rupees. Have you understand this? And fixed cost is 80,000. There is no change in fixed cost. Okay, next, manufacturing overheads. I am classifying variable is 3 rupees, fixed cost is 60,000. Selling and distribution overheads, variable is 2 rupees, fixed cost is 20,000. Okay, now cost element of quarter 4. Material A, B, 5 rupees, 6 rupees, 5 rupees. Labor, variable cost 9 rupees. Variable, how to get 9 rupees? Existing is 10 rupees. Increase of 12.5%. So 112.5% and decrease due to learning curve, that is 80%, will get 9 rupees. Same way 15 rupees. This is for overtime. This is for overtime. When the overtime applicable more than 19,000. When the production is more than 19,000, overtime applicable. So variable cost is 15 into 112.5%, 80%, 13.5. Fixed cost is 80,000 into 112.5% because labor cost is increasing. Labor cost. When I say labor cost, variable cost and fixed cost both will increase. Variable cost and fixed cost both will increase. Okay. So 80,000 into 112.5, 90,000. Okay. Next. Manufacturing overheads, variable cost equal to 3 rupees and fixed cost equal to 60,000 into 120%, 72,000. Depreciation 20,000, administration expenses 25,000, selling and distribution 2 rupees, 20,000 into 120%, 24,000. Okay. So this is what the cost element. This is what the cost element for the, again, this is the answer for the first requirement. This is the answer for the first requirement. Are you understanding? Look at the solution. ₹6, ₹5, ₹9, ₹3, and ₹2. Here they get ₹6, ₹5, and ₹10, 80,000. That 10 will become 15 for overtime. Okay, let's go one by one. Material, that material ₹6, ₹5. That's how we calculate it. Next, fixed and variable component of production labor cost. When it comes to labor cost, see here we need to take 10,000 and 15,000, not the second quarter. Second quarter is 20,000 because there is a overtime premium. Don't take that. Take 10,000 and 15,000, which is less than 19,000. So take both. Changing cost divided by change in unit, 10 rupees, and fixed cost is 80,000. Variable cost of 20,000 units, 10 per unit, 2 lakhs, and fixed cost is 80,000. Overtime premium 5,000. How we are getting 5,000? See here, 1,000 units. 20,000 means how many units? More than 19,000, 1,000 units. And each unit is going to get the premium of 5 rupees. So it becomes 5,000 rupees. Total 2,85,000. Next, quarter 4, 18,000 units. For 18,000 units, it is 10 into 112.5% into 80%, 9 rupees. So 1,62,000 fixed cost is 90,000. Total it come to 2 lakh 52,000. Okay. Fixed and variable component of manufacturing overheads. Variable, I mean, changing cost divided by change in units, 3 rupees per unit, and fixed component is 1,20,000 minus variable cost. 1,20,000 minus variable cost 60,000 per quarter for 20% increase, so it will become 72,000. Next, fixed and variable component of selling and distribution expenses. So changing cost divided by change in units, so you get 2 rupees per unit. Fixed cost is 20,000. After increase 24,000. Using this information, we are going to calculate it for the fourth quarter. We are going to calculate it for the fourth quarter. Total fixed component 0 here. Here it is 90,000, 72,000, 20,000, 25, 24,000. This is for the quarter 4. This is the variable and fixed cost component for the quarter 4. Next, flexible budget for production cost of quarter 4, 15,000 units, 18,000 units, 21,000 units. Please be careful with the 21,000 units because it is more than 19,000. It is more than 19,000. We have to take the overtime premium, which is at the rate of 15 rupees old. When it comes to new, 15 into 112%, 112, sorry, 12.5% extra. So 15 into 112.5% into 80%. Okay, look at here. See, here they calculated. 21,000 into 9, 2,000 units at the rate of 9 rupees 50 paisa. I mean 50% is the premium. 2,000. See, extra units is 21,000, which is more by 2,000 units compared to 19,000. So 2,000 into 9 rupees into 50%, 9,000. Okay. Now variable is 1,89,000. Fixed cost is 19,000. Premium is 9,000. Totally 2,88,000. That is what they taken here. Okay. Now manufacturing cost 1,70,000, 1,26,000, 1,35,000. Manufacturing overheads. This is the calculation. Okay. Now depreciation 20,000, 20,000, 20,000. Total production cost 5,27,000, 5,96,000, 6,74,000. Have you understand this? See, budgetary control. This question is all about classifying. See, most of the question which we solved, they had given the semi-variable cost, and we are classifying into variable cost and fixed cost. Very important. Even in the budgetary control, also they implemented that. Even in the marginal costing, also they taken the same thing. And when it comes to budgetary control, they given few adjustments for the quarter 4. One of the adjustment is labor cost. Second adjustment is increase in the fixed cost. Are you understanding? So this is about RTP discussion. This is about RTP discussion. So wherever you get the doubt, please mention in the comment section. Definitely I'll revert back out. I know that I'm going a little bit fast only because I have to save your time also. So that I'm going a little bit fast only. Okay. Thank you.